Good morning, everyone. A warm welcome to each customer, business partner, and colleague attending the PAGSA Mid-Year Tax Seminar. We are very privileged to have Rob Cooper as our presenter. Rob, thank you so much for the valuable information and knowledge that you will be sharing today. We are very excited and we are looking forward to your presentation.
Right, thank you very much. And is it over to me?
Yes, thank you so much. It is over to you.
Right. Well, good morning to everybody. And I think firstly, a welcome to the ANC, which is not the government, but the ANC is controlling the webinar this morning. And that ANC consists of Annelie and Chantel. So the government isn't sitting in. But a big welcome to them because they make this whole thing happen, and thank you very much. Then, of course, welcome to all of you who's sitting in this morning. I trust that you are all well wherever you are. Some of you might be in your offices, others probably mainly at home and sitting in and listening to what we have to say about what has been happening in the employment tax world in the last 6 months or so. And it's been a hectic ride, as we're going to see. The session, and by the way, just to say that as I feel my throat, I was up in Gauteng for 2 weeks, straight after the provincial borders opened. I came back on Monday and I'm down here in the wilderness area near George, and the fynbos here hits you a little bit, so my voice is scratchy, so apologies for that, but with some water and maybe something else, I'll get through the session this morning. I trust you all well. Just to say further that these webinars are obviously a wonderful thing in a lot of ways. You know, you can watch from the comfort of your home. I do find, having done seminars for many years, that I miss I think the word is the connection of a seminar compared to a webinar. At the moment, I'm connecting with a screen. You are connecting with a screen as well. You have your house or your office going on around you. And I prefer the environment of a seminar, and who knows what happens in the future. Perhaps we're going to see a mix of webinars and seminars down the line, which I think will be a good thing. Then you can make your choice. Seminars are obviously more expensive because the venues are hellishly expensive, in my opinion. They're overpriced. So we'll see what happens in the years to come. But yes, we're into a webinar. There's some great advantages to you. You can make your own tea and snacks. You don't have to rely on the venue. You don't have to be on the highway. But if you miss those sort of experiences like the highway, you can always just pop in your car and just take a quick ride. And just moving to the slides, this always gives me a bit of a shock to see myself, as I was, I guess, 15 years ago. The slide is just here just to say that my activities now are as chairman of the Payroll Authors Group, which is a group that represents the payroll supply companies in the country. We sit between the statutory bodies like SARS and UIF and Compensation Fund, Employment Equity and so on, and then the payroll companies. So we have an impact, and the information that I'm putting across to you is very much part of my activities of this group. And you can see it's been around a long time. 1988 we were established for the first time. So that was just a brief introduction. This is just a few things about the Payroll Authors Group. By the way, that funny name, the Payroll Authors Group, was coined by SARS when we were established. in their thinking, we were companies that wrote payroll software. So writing things, they came up with this word author and obviously payroll. So it has stuck, and we are now the Payroll Authors Group of South Africa. So yes, established then, active encouragement and support of SARS, which we've had ever since then. They've actually been fantastically supportive of the group, which helps you. So the 35 payroll members that we have of the PAG, which includes PaySpace, they're a prominent member of the PAG and sit on the board. We sit between them, and the PAG informs the payroll members, and there's this communication that goes on between us, and then of course between the payroll author like PaySpace and their clients. We have open membership for just normal employers as associate members, as you can see there. And if you're interested, there's some information there. I wouldn't say it if I didn't think it's of value to you. Good. Let's just look at the agenda. And as I said earlier, we're here to update you on what's happening at the sort of mid-year point, halfway through the current tax year, the 2021 tax year, to update you on what's going to happen, and also a little bit just going back in the last 3 months, because we've had a hectic and bumpy ride over recent times. So I'm going to start with just dealing with some easy things, rates and thresholds and so on, just to break the ice. And then there's a lot happening around labour law changes, particularly TERS, which I'll be talking to you about just now. And then, of course, we had just completed, rather, in most cases, the 4-month period of the disaster management tax relief bills, which was dumped on everybody in a rush and under huge pressure. And I think that SARS and National Treasury did an excellent job under huge pressure of getting out all of the changes to legislation. But more of that later. And then the tax law amendments are looking at a bit at the future. There are not too many of them. I think there was so much pressure on everybody that there aren't too many at the moment, but there are some important ones looking ahead. So these will be changes for next year. And then lastly, just a sort of a catch up around the UIF TERS benefit. I can't present everything on the TERS benefit. For those of you who attended the PaySpace Power 2020 conference, I did a more comprehensive presentation of TERS there, but that is 2 hours on its own. So the scope of the time frame this morning doesn't allow me to do that. So that's broadly what we're going to be talking about today. You were issued apparently with the slides. If you have the slides there, or have printed the slides maybe, or on another desktop, you will see that in the bottom half of each slide, so the slide is in the top of the page, in the bottom part of the page, there are some notes to assist your understanding. And this obviously is both for now and for later reference purposes. I will also be writing a more detailed manual around the contents of today's session. That should be completed by early next week sometime. And then along with the FAQs that come out of the session, PaySpace will distribute that to you. The reason that the manual isn't completed is that I can't see myself, but if you look closely on my forehead here, you'll see the words TERS, which stands for TERS. And it has just been unbelievably hectic in last times. And you no doubt have seen the press reports this morning that quite a number of the senior management, including the Unemployment Insurance Commissioner, have been put on precautionary suspension. I just want to say that while we had great difficulties with this process of TERS, it was obviously hugely problematic for the fund as well to create new systems and a new benefit under the pressure that they were, was very challenging. So it appears to me that the problems are around possibly leaks in the system, as what it might be around people, but we have to wait for this thing to run its course. There are very good people at the Unemployment Insurance Fund. So I just wanted to mention that. But they've obviously been under huge internal pressure over the last week, and that has implicated on queries that I still have with the fund and their ability to get back and to resolve those queries. So I'm talking too much. As far as breaks are concerned, sort of roughly every hour, we can take a 5-minute break. I'll just break at a suitable point where we are, as far as the topic is concerned. And then, Annalie, while I'm talking, and you maybe submit queries to her through the chat box, she will be analyzing and consolidating those queries. So hopefully around about 12 o'clock, we'll be finished with the presentation, and then we'll take another 5-minute break, and then I'll look at the queries and talk through the queries as much as possible. Because again, in terms of trying to simulate a seminar experience in a webinar, queries is a big part of it. The benefit of a seminar is that everybody's in the same room, you're focused, and you benefit from both the questions and the answers that, the questions that other people ask. So let's see how those go, but that's a plan for the morning, closing then at around about 12:30. Good. This I always do, it's just a brief overview of how employment-related legislation and legislation in general unfolds. So if you look at that frame at the top, this represents the calendar year of 2020, so starting there from January and going towards the end year, November 2020. And the little arrows at the top indicate that the 2019 legislation changes in respect to the 2019 calendar year came to its endpoint, which is called promulgation in January 2020. Promulgation is when the state president signs the final bills which have been approved by Parliament, as we'll see. Then the bill turns into an act and it is final law. It can't be changed unless you return to the process that I'm going to describe to you briefly here under the blue arrows. So this current 2020 year, the changes to legislation start with the budget. The budget makes proposals to amend, to change various laws, including employment-related laws. And then the drafters of the legislation get together under huge pressure this year, and they turn the proposals into legal language, and they're issued in draft bills, which somehow or other Treasury still were able to do. They normally come out in mid-July. This year they came out on the 31st of July, so a little later, which is quite understandable. And then organizations like the Payroll Authors Group, SITE, SIPA, and so on, we comment on those draft bills. And the comments then are submitted to National Treasury and to SARS, and we then have a workshop situation, which is coming up. It's quite soon, in about a week's time. I think it's next week, and we obviously began to doing that workshop virtually, where normally everybody gets together. And this is where we are then in the red frame. The Payroll Authors Group has already submitted public comments to Treasury, and we are going to be having the workshop situation then very soon. The bill that comes out of that workshop situation, the revised bill, as a result of the comments, goes to SCOF, the Standing Committee of Finance, around about September-ish. They can still make final changes there, and then a final bill comes out of that process, and that final bill goes to the National Assembly, NA, and from there to the National Council of Provinces. Pretty much a rubber stamping process. The hard yards have been done in this process between the budget and SCOF over there. And once it's been rubber stamped in these situations, it then wraps around again. You get back to the state president signing, the legislation is promulgated, and it takes effect on the effective date that is specified in the legislation. So in this 2020 year, there are 18 various bills, regulations, acts, notices, and so on. 5 of those bills are tax related. So the other 13 items are to do with labour law. So labour law has been very active over the past couple of years. And just to say that tax law in this process that I described, from budget wrapping around into promulgation, most tax changes go through in the 12-month period. So only big ticket items like retirement reforms, for example, foreign employment income, which takes a bit longer. But most tax items in a year, whereas labour law traditionally takes a couple of years, as we're going to see, for them to go through the same process. It just takes longer. So there's the summary. If you have your notes that were issued, with the slides rather, in the notes section of those slides, you'll see the actual detail of all of these 18 documents that have been issued. Let's move on. And as I said earlier, let's start with the easy stuff, the rates and the threshold changes. And we start with the official rate of interest because it always changes. It is a rate of interest that's linked to the repo rate, and the repo rate changes fairly regularly. So the official rate of interest is 1% above the repo rate, and it changes on the first day of the month after the month in which the repo rate changes. Now, you can see in the top left-hand side of the screen just a summary of the changes to the official rate of interest, the ORI, and the dates, and we are now at 4.5%, which means that the repo rate is 3.5% because the ORI is 1% above. So you can see just in recent times the dramatic drop in the official rate of interest. It might have bottomed, who knows? It could still go lower. You can see here just a summary since 1985. Twice we went up to 19% on those two occasions. And prior to the 4.5% where we are now, 6% was the lowest back in 2012. So we are very low in terms of interest rates at the moment. Now, what is the official rate of interest? It's a rate of interest that if you as an employer grant loans to employees, then if the interest rate that the employer charges on that employee's loan is less than the official rate of interest, currently 4.5%, then you have to calculate the difference in the interest amounts in rand terms between the 4.5% of the official rate of interest and your lower rate of interest, which could in some cases be 0%. So the difference in the value of the interest in rands terms is a fringe benefit. It's a low interest loan fringe benefit. It has to be processed through the payroll and obviously then taxed. So the employee is taxed on that difference. The rationale being that the employee is getting a loan from the employer at an interest rate which is generally lower than the prevailing interest rate that's available on the outside. And the employment relationship which exists means that the employee is getting an advantage, a benefit from the employer. And as soon as you get a benefit from the employer in the employment environment, it translates into a fringe benefit. So that is the principle. There are 3 exceptions where low interest employee loans are not taxed. There's no fringe benefit, or the fringe benefit is given a 0 value. The one is the casual loan, as it's called, and a casual loan is if the loan is up to an amount of 3,000 rand, firstly, and secondly, if it is made infrequently. So the 3,000 rand loan value is easy to monitor, but infrequently is a concept that's not defined. It's sort of how long is a piece of string, but a bit of guidance that if SARS ever audited your employee loans and they picked up that you were granting 3,000 rand loans to employees on, let's say, a 3-monthly interval, SARS would see that to be frequent, not infrequent. So they would then expect the fringe benefit to be raised. Once a year, maybe SARS would see to be infrequent as far as a casual loan is concerned. The other one is the study loan, where again, if the interest rate is low, there's no fringe benefit raised. Study loan is a loan made to the employee in respect of assisting that employee with their studies. And there's no value as long as the loan is made to assist the employee to study. So there should be a bit of due diligence from the employer when you make the loan and just following up, how's it going with the studies? Is the money being applied? That sort of thing. But no interest on study loans. And then the third one is a relatively new one. I think it's 3 years old now. And that is a loan from the employer to the employee to assist the employee to gain ownership of residential accommodation. So this is to assist people to get a roof over their heads, and Treasury is is giving up the tax. It's called tax foregone, and saying employers must not tax those loans to employees if it's in respect of a house, and the interest is zero or low. There are two conditions there. The market value of the house must be less than 450,000 Rand, and the employee's remuneration proxy must be less than 250,000. Remuneration proxy is something that stands in for something else. So remuneration proxy means essentially the employee's remuneration as of the previous year. So you make the loan in this current tax year, shall we say, you look at the employee's remuneration from last year, total for the year. If that's less than 250,000 Rand, then one of the two conditions have been satisfied and the fringe benefit can potentially not be taxed. Good, that's the official rate of interest and loans to employees. Then just a brief history here. I find it easier to talk around a table like this. And these are other thresholds and limits that are applicable in the employment environment and around payrolls. Let me just start perhaps on the right-hand side. COIDA, Compensation Fund. You can see that there are regular changes. Every year there's a change. This is to what is called the earnings limit. So there is a special, not even a definition, but an interpretation of what earnings is for the purposes of the payroll having to accumulate those earnings for every employee and to report at the end of the year only up to that earnings limit. So you can see the latest threshold, 484,200 from the 1st of March 2020. So this is for the year ahead, the 2021 year of assessment for the compensation fund. I'm going to talk a bit more about the year of assessment for the compensation fund just now. Then moving left, the basic conditions of Employment Act, also earnings. The earnings there are again different from what earnings are for the compensation fund. Used to be a regular changer, last change in 2014. The reason being that in 2014, the Labour Relations Act was changed to bring in this rather confusing concept in labour law of a deemed employee, an individual who's deemed to be your employee. It applies mostly around labour broker situations where the worker is provided to your company, to the employer, by a labour broker. For the first 3 months, the worker is clearly the employee of the labour broker, but after 3 months, that worker is deemed to be the employee of the client company. But this deeming provision only applies if that worker earns below the earnings threshold, which currently is 205,000 Rand per annum. So they are keeping the threshold low, I think, to artificially reduce the number of cases of deemed employment, while it still finds its feet in the legislation, wends its way through the courts and so on. The other application of the BCEA earnings limit is around overtime, which is the most widely used area where it's applied. So if one of your employees works overtime and earns below 205,000 Rand a year, then you must pay the overtime. However, if the employee works overtime and earns above 205,000 Rand, it's your choice as an employer. It's optional whether you pay overtime or not. So very important from that point of view. And there's a couple of other areas in the BCEA that this threshold governs. Then moving left again, we have two columns here and two separate limits for unemployment insurance. So starting just with benefits, there's a benefit limit, which is 17,712, probably quite a familiar figure for most of you with the recent TERS calculations. And that limit is from April 2017. Then the second limit is to do with the contributions. So benefits, the benefit limit is applied by the fund when it calculates the benefits. And I'm going to illustrate the benefit calculation for TERS towards the end of the session this morning, and you'll see how it's applied. So this falls under the Unemployment Insurance Fund. The Unemployment Insurance Act is administered by the Department of Labour. However, as far as contributions are concerned, we have a different scenario. It's the Unemployment Insurance Act, which is critical. It is administered by SARS and falls under National Treasury, and it prescribes a limit, which you're probably all familiar with, which has remained unchanged since 2012, 14,872. So payrolls apply this limit. In other words, they only calculate the 1% plus 1% UIF contribution up to 14,872 per month. So you cannot get a 1% contribution higher than 148.72 coming out of that process. One amount for the employee, one amount for the employer. Now, as you can see, it hasn't changed for a long time. As you no doubt are aware, the contributions represents the inflow of money into the fund. That's the pipe of money going in, whereas benefits is a pipe of money going out. I'm going to mention this again just now, but perhaps I can also just say quickly that I expect that perhaps even in this year that we're going to see an increase to the contributions limit. In other words, the pipe of money going in is going to get bigger. The fund, as you've already in the press, is under huge pressure financially. They fortunately had a big surplus that was built up over the years. They were very strong financially, which has helped a lot to get us through the lockdown period and the TERS benefits. But obviously, if you're paying out huge amounts of TERS benefits on the one hand, plus a huge amount of retrenchments, normal unemployment in benefits being paid out as well, because they have spiked in recent times. And then at the same time, your inflow of money is dropping because people have been retrenched and businesses are closing down. Then, you know, it's a three-way whammy as far as the fund is concerned financially. We had to talk a bit more about that later. So I'm expecting an increase here, but these are what they are. We'll see the 17,712 a little bit later. Good. Let's start with updating you in some of the processes around labour law. Some are still ongoing, others have come to an end. And having just spoken about the compensation fund, there is a bill. In other words, it's in the process of being finalized. Incidentally, it looks as though this bill, which is about 2 years old, is going to be finalized this year. The final bill you can see in that Gazette was published very recently. It's hot off the press, and it's on its way now into Parliament and that sort of process. So I expect by the end of the year, this will be an act. And these changes that I'll just summarize for you quickly will be final law. And we'll see what effective date they put down in this final process as far as applying this final law. So what does it do? At the moment, in the definition of an employee for the compensation fund, domestic workers are excluded. Now, the Act will then remove that exclusion. So that means that domestic workers will become an employee in terms of the Compensation Fund Act, or COIDA as it's called. Probably the same process for the employer, which is the householder, the domestic employer, in the same process in the sense that it would probably at this stage be an annual return. But then domestic workers will be covered in terms of injuries and diseases in the workplace. The workplace can be in your house. It can be in your garden. Those people working in the garden are domestic workers. It can be in your car. Chauffeurs, au pairs, they are defined to be domestic workers. So that's coming. Then this seems to me, I don't know a lot about it, but this obviously seems to be focused on the building industry. At the moment, the current legislation has this term a mandator. So a mandator is somebody who mandates something, gives instructions to somebody else. So this is typically the arrangement where you have a builder and subcontractors who might again subcontract themselves, and they're all on the building site, and they have to be protected because a building site is a very dangerous place. So I think to try and clarify this relationship, they've replaced mandators with contractors and subcontractors. Not really my field of expertise, but I can see where it's going. Then a big thrust of the legislation is to improve, simplify, speed up, make less costly the process of rehabilitation of an employee who has suffered an occupational injury or disease in the workplace. Again, not really, my speciality at all. I deal with the money going into the fund, but from all reports, this is going to make things a lot better. In past years, you've seen, a huge number of court cases against the fund who have not paid medical doctors, medical providers, and so on. And I think this is all part of the process to streamline the administration, make it work better, and apparently less costly as well. It's hugely costly at the moment. Then, yes, I want to step up compliance and enforcement and so on. And lastly, they want to align the financial year of the compensation fund to that of the Public Finances Management Act. Now, Public Finance Management Act has a financial year, a fiscal year of 1 April to 31 March. However, for those of you who do the annual returns, that WAS8 form, or the return of earnings as it's called now, you will know that that return is in respect of a tax year. In other words, a 1 March to 28 February year. However, all of the other provisions in the fund, including the way that they used to issue the annual limit, is around a Department of Labour year, a 1 April to 31 March year. So it looks like they intend to change everything across to that year. And they're just going to have a phasing in process when this happens. So we don't know the effective dates. I would just assume if it goes through the process this year, that most of these changes probably are going to be made effective from the start of the year of assessment for 2021. But that remains to be seen. Just lastly to say, I mentioned earlier when I was talking about the earnings thresholds and so on, it's hugely complex for payrolls and for employers because there are different definitions of remuneration. There's about 6 or 7 different definitions. There's a definition of wage. There's a couple of definitions of earnings, and it makes it all very complicated when they differ widely from one another. So the Unemployment Insurance Fund in 1999, the Payroll Authors Group sat with them for a couple of years when they brought out their new legislation in the year 2000, with it a new declaration for payrolls to comply with, to declare. And in that process, we recommended to the fund to move away from a Department of Labour definition of remuneration and use the 4th schedule definition. 4th schedule definition of remuneration, let's call it the remuneration that pay as you earn, is based on. The reason for that is I think that most employers, most people, including employees, have a fair knowledge around what is taxed as far as pay as you earn is concerned. In other words, what is remuneration in terms of the 4th schedule, whereas the knowledge of remuneration on the labour law side is sketchy. So the fund accepted our recommendation. We now have in the Unemployment Insurance Contributions Act, it relates to the definition in the 4th schedule, with 1 or 2 exceptions, like notably commission, which is subject to pay as you earn on the tax side, but commission is not used to calculate the UIF contribution. It is excluded, which I think is wrong. And I hope that we're going to see a change to that in the future, but that's certainly how it is at the moment. Anyways, I proposed in a presentation to the board that they also in the future consider moving to the 4th schedule definition and away from the concept of earnings, which incidentally is not defined. there's an interpretation, and that interpretation goes back to the mid-90s. I know because myself and Ron Warren were there, and that interpretation is still the interpretation that's on the back of that return of earnings forms, and it hasn't stood the test of time. It's outdated and it needs a revisit. So the presentation, I might say, was well received. It was a year and a half ago. I haven't heard anything since then. I'm not really expecting things to change. Well, I hope they're going to change, but not quickly. These things take time. So let's see what happens in the future. But that's the compensation fund. Then moving across to employment equity. Here we have, after 2 years, a bill that was introduced 2 years ago, which again, its final form has just been published, 20th of July 2020, and it is moving into the National Assembly and the National Council of Provinces for approval. And again, then I'm expecting towards the end of the year that this will be final legislation. Generally, it can vary per employer, but the equity year, if I can call it that, is a 1 October to 30 September year. So I'm not sure if this legislation gets finalized quickly, whether they are going to link it to an effective date, say 1 October. We're just going to have to see. What does it do? A very important aspect is it changes the definition of what's called a designated employer. Excuse me. Just taking a step back, remember that the Employment Equity Act is broadly divided into 2 areas. You have Chapter 2, which deals with unfair discrimination, and Chapter 2 applies to every employer in the country, from the smallest to the biggest. So a sole trader who has an employee would be, a designated employer as far as unfair discrimination is concerned. That's Chapter 2. Then the other area is Chapter 3, which deals with affirmative action. In other words, trying to redress the wrongs of the past. And that Chapter 3, affirmative action, only applies or must be complied with rather by designated employers. So there's a definition, and the definition is going to be changed. And broadly what the definition used to say is that all employers with more than 50 employees are designated. And by the way, if you are designated, the main impact of that is that you have to submit an equity report every year, normally around that equity year that I told you, but some employers have different years. So if you're designated, you must submit a report. If you are a company with less than 50 employees at the moment, then you are not designated unless the turnover of your company exceeds various turnover thresholds that have been specified per industry sector. If your turnover does exceed those thresholds, then you are designated. The change is that they're going to take away those turnover thresholds. So this means it's going to be a simple case. If you're an employer with more than 50 employees, you're designated, you must submit a report, an equity report. If you have less than 50 employees, you're not designated, and you don't have to, by law, submit an equity report. By the way, if you're not designated, you can always voluntarily submit a report, because part of the process for tenders is that you have to be compliant with employment equity, and the compliance goes around, have you submitted a report? Are you making progress towards your equity targets and so on? So if you're not submitting a report, then how can you be compliant? And you might want to, apply for a state tender. So how it will work in the future is that if you're not designated and you've decided not to voluntarily submit, which is probably a good plan, as long as that smaller employer complies with Chapter 2, that's the unfair discrimination side of that. By the way, they'll measure that by just looking at the cases against the company in terms of unfair discrimination. So if you comply with Chapter 2 and you comply with the national minimum wage, which came in obviously January 2019. So If those two boxes are ticked, then the small employer can get a certificate of compliance, which is an electronic process, and you can then tender for state contracts and so on. So quite a significant change there. Then just as far as the, the equity reports are concerned, still not quite clear on this, but remember the purpose of the report is that the employer has to examine their workforce profile, analyze it in terms of the racial groupings, the gender groupings, disability, and also foreign and local labor. And then you submit a report around that, and you have to try and get those groupings within your workforce profile aligned over time with either the national or the regional demographic targets. That is how it has always been for many, many years, since 2001 with equity. So what they've done is they've introduced a sectoral demographic as well. So these are demographics per sector, like security or financial. And these have now been introduced in the legislation. Now, my understanding from the last meeting that we had with Employment Equity, which was just before the lockdown, it was in February, is that the sectoral targets will not be applied by the employer. It seems like the employer will continue to focus on either national or regional targets, demographic targets. On assessment, however, they will assess the return against all three, national, regional, and sectoral demographics, which seems to me to make it perhaps easier to achieve targets because there's three options. But I think we're just going to have to see how this unfolds in practice. But this is my understanding from that meeting earlier this year, which hasn't been followed up on. Lockdown interfered in the process. So that's the legislation, broadly quite nice as far as employers are concerned. Then there is a regulation. Now, this regulation is final from August 2019. And remember, a regulation is something that gives administrative teeth to the legislation. The legislation is the Act, and then the Act in various places says these numbers, these limits, this process, these dates, or whatever it is, the sort of administrative side generally can be changed by regulation. If you have to change those limits and dates and so on in the law, in the Act, you have to go through that yearly annual process that I described earlier, which is clumsy and it takes time. A regulation is much quicker. So in this case here, this regulation that was issued made significant changes around the reporting requirements for employment equity. And again, there are two areas of reporting broadly. The one is for short termed the EEA4. It is to do with the money. The other area is the EEA2, which is to do with the heads, with the people, the workforce profile. So it's only on the money side that we have a change and significant changes. Now, this has a big impact on payroll suppliers because they have to make these changes happen in their systems. And as you can see, it's already happened. So there've been a lot of changes to the tables, reports, calculations, and so on. And not too much the problem of the employer. As I say, the payroll must do its job there. However, I think employers must be aware that the policy, the focus for future years is they intend to look at this wage gap, as it's called, the difference between high and low. And it's not just the highest wage in the company and the lowest, which is the gap. It is per the categories, the occupational categories. It is per the racial groupings, the gender groupings, you know, foreign, local employees, disability. So all of those areas, they'll be looking within each category. They'll be looking at the wage gap there. So good luck to them, in my opinion. I can see the rationale, but good luck. To do this, they had to split the concept of remuneration in the Employment Equity Act into two broad areas, fixed and variable remuneration. Because you can appreciate that there is no point in trying to analyze a wage gap if the proportion of variable remuneration is high. Variable remuneration being overtimes, commissions, performance bonuses, and those sort of things. Fixed, the fixed regular, the salary, the wage, the fixed allowances, things like that. So again, this is a change in the reporting. They obviously will be analysing the wage gap against the fixed portion of remuneration. So it's complex. As I say, good luck to them. I think there's problems that lie ahead in the future to make this work. Lastly, just to say that, as I said, it's only the EA4 that is changed, but the workforce profile, as a result of these changes, we can see that it is being impacted on. Remember, this is reporting the heads, the workforce profile, again in those various groupings. So in the meeting in February that I spoke about, we were starting to talk about changing the EA2 as a result of what's happened in the EA4. So yeah, this must still happen. It has been postponed because of the lockdown, but I think that there are changes coming as far as that aspect of employment equity reporting is concerned. Let's see how it works out. That's employment equity. Then I've summarized this long and winding road that we've had since 2017 up until April 2020. So it's 3 years of a bumpy road, a long and winding road of the rollout of the Unemployment Insurance Amendment Act, and linked to it, the Labour Laws Amendment Act. So I'm going to be brief here because the road has come to an end, April 2020, as we'll see just now. I just want to wrap it up quickly for you. And just to say that the Unemployment Insurance Amendment Act, when it was promulgated, signed into law by then President Zuma in January 2017, broadly did 6 things. You can see there are 5 aspects of that act, which I'll just run through very quickly. I'll deal with the 6th one, which is not on the slide just now. So what it did, and they're generally 5 very nice things, it's to the benefit of employers and employees. It made it clear that learners and foreign nationals are eligible for benefits. And just to say that on the contribution side, because obviously unemployment insurance is an insurance product, it's like your car insurance, there's a premium and there's a risk that's insured, and if the risk arises, you get a payout. Exactly the same principle. Contribution is the premium, and from March 2018, SARS changed the Contributions Act to say that learners and foreign nationals must contribute. It was also changed, or it wasn't changed because they were never there, but public servants do not contribute to UIF, but what was changed is in the Benefits Act, the Unemployment Insurance Act, that public servants do now get their benefits through the same process as what we do as commercial employers. So they don't contribute, they do get a benefit, and obviously money changes hands in different ways. There's some sort of a reimbursement process, a government process. So that's the one change. Administration requirement around benefits significantly improved. I'm not going into details, particularly around maternity benefit claims. I've simplified it a bit, made the periods for maternity and unemployment longer in which you can claim. So significant changes there. And then what was introduced is something that's become quite topical, the RWT benefit, or the reduced working hours benefit, was introduced. I'll give you the effective dates. This is obviously where the company is in difficult times, and instead of retrenching, they move to a short-time arrangement. And it could be, shall we say, they agree on 6 hours a day instead of 8 hours a day, or 3 days a week instead of 5 days a week. Some sort of a short-time arrangement is made, which reduces the wage financial stress on the company to help it get through the difficult process that it's in, or difficult time. But as far as the employees are concerned, of course, they are being paid less wage. So this benefit is designed to fill the gap between the normal 8 hours of wage and the short time of 6 hours. Just to say at this stage that it's a problematic benefit. I don't really think that it is worth all that much, but let me explain that a little bit better later when we come to the TERS benefit. Then, importantly, the value of the benefit has gone up as a result of a number of factors. Firstly, the benefit value calculated by the fund is generally based on a rate per day, which I'll explain later, times the number of days. And the number of days for most benefits is based on what is called credit days. And credit days are accumulated by the fund. It's not a payroll function, but it accumulates now at a rate of 1 credit day for every 4 calendar days in a month in which a contribution was made. If there's no contribution, there would be no credit days, but otherwise at a rate of 1 in 4. It used to be at a rate of 1 in 6. So it accumulates faster than it used to, so there are more credit days, which leads to a bigger benefit. It accumulates still over a 4-year period. So if you accumulate at a rate of 1 in 4 over a 4-year period, then at the end of the 4 years, you have 1 year's worth of benefit, which can be paid out. That is obviously if you don't claim during the 4-year period, because if you claim, the days that are used to calculate the benefit are then set to 0 because the benefit days are translated into money in the form of the benefit. So a significant change there to increase the value of the benefit. As far as maternity is concerned, they used to use the income replacement rate table, which I'll talk about again a little bit later, where a percentage is applied to the daily remuneration rate, varying from 38% for high income earners, people who are above the benefit limit, to 60% for low income. So there's cross subsidization in that income replacement rate calculation, the IRR. But that has been taken out as far as maternity is concerned. There's a fixed flat rate of 66% for maternity benefit claims. So that's obviously higher than what the higher was. So as to the benefits of the ladies involved. And incidentally, just a bit of trivia for your interest, there are 9 different types of unemployment benefits. All of the benefits that are to do with a child, like adoption, like commissioning leave that we'll come to, like parental leave, like maternity leave, all of those use a flat rate of 66%. That's how the law has been changed to standardize it. Whereas the others, you know, the unemployment benefit, the reduced working time benefit, works using the income replacement rate, the cross subsidization. Then lastly, a change was made around 3rd trimester miscarriages and stillborns. The value of the benefit was based on a 6-week period. That has now been aligned with normal maternity, 4 months. 4 months times 4.33 weeks per month on average gives you 17.32 weeks. So that value has gone up as well. Now, the legislation, as I said, then President Zuma signed it into law on the 19th of January. It was promulgated. It was a final legislation. How it happened, I don't know. How it slipped through the process, but there are 2 serious drafting errors in that final legislation, which delayed the implementation of this very nice piece of legislation for 2 years until January 2019. The 2 serious drafting errors was instead of accumulating at 1 day for every 4 calendar days, somebody slipped in a 5 at a very late stage, because I saw the earlier draft legislation was 4. So somebody changed it to 5. And instead of saying 17.32 weeks, somebody or a word checker or something changed it to 17 space TO space 32. In other words, 17 to 32 weeks, which has a totally different meaning than 17.32 weeks. So the legislation couldn't be made effective with these 2 errors. So what did they do? They looked around to other legislation to try and fix these errors. They saw that the Labour Laws Amendment Act was in the process. It also falls under the Department of Labour, though it was introduced by Caroline Duncan, a Member of Parliament for the African Christian Democratic Party. So bills can be introduced by members of parliaments, normally as statutory bodies like SARS, UIF, Treasury, etc., who introduce legislation. And the Unemployment Insurance Fund hijacked the Labour Laws Amendment Act to fix those two errors on the previous slide. So I'll explain the result on the next slide, but this is what the Labour Laws Amendment Act does, which is very significant. 10 consecutive days of parental leave. I'm sure you're all aware of this now, called paternity leave, because that's mostly it will be where it will be applied. It's for the father of a newborn child, but it also links down those 10 consecutive days down to adoption leave, where we're coming to, and commissioning parental leave. So this is hugely important. For the first time, men are going to get their rights, and they are going to get 10 days of leave around the birth of a child, in which they can relax a little bit. This birth of a child is hugely stressful for fathers. They need time to relax, sit on the couch, braai, play a bit of golf, that sort of thing. So finally, after decades of trying, we now have parental leave or paternity leave. There's a whole lot of implications around this and how it's applied. One aspect I must point out to you is that in the past, prior to paternity leave's introduction in the BCEA, we had family responsibility leave, and in the event of the birth of a child, the father, the employee, was granted 3 days of employer-paid family responsibility leave. Now that falls away. It is replaced with 10 days of parental leave, but we're coming to it now. But let me just mention that parental leave is not paid for by the employer. It is paid for by the Unemployment Insurance Fund in terms of the Unemployment Insurance Act. So family responsibility leave around the event of a birth is gone. The other aspects of family responsibility leave remain, sickness and illness in the direct family and so on. Then we have 10 consecutive weeks of adoption leave. By the way, the consecutive in all cases means calendar days. So 10 consecutive days would always include 1 weekend. So its value is based on 10 consecutive days when calculating the benefit value. The fund reduces everything to calendar days when calculating benefit values. And here we have 10 consecutive weeks. If there are 2 adopting parents, then the one adopting parent can apply for the 10 consecutive weeks. The other adopting parent can apply for the 10 days of parental leave. So that's how parental leave links down to adoption leave. And then we have a similar concept, 10 consecutive weeks, around what's called commissioning parental leave. This is around surrogate motherhood arrangements. Again, if there are 2 parties involved, one of the 2 can apply for the 10 consecutive weeks, and the other one for the 10 consecutive days. Okay, so there's no limit to the number of 10 consecutive days in a year, incidentally. It could happen around the birth of a child. It might have happened first for adoption because the couple couldn't have a child. They adopt, 10 days of leave are taken here around adoption, and then lo and behold, they have a child later, and then the father again is entitled to the 10 days of parental leave there. So there's no limit. One of the problems, I believe, around paternity leave is that you can have, as long as the event happens, the birth of a child, the individual employee has become a father. Every occasion entitles that person to 10 days of parental leave. So 17 children, 17 times 10 days of parental leave, which is paid for by the fund, but it means that that person is out of the workplace. So there's a cost to the employer of absence and maybe replacement for those periods. So maternity leave, obviously, there's some biological limits around how many maternity leave benefits you can get over a period of time. There's no biological limit around parental leave. And I seriously think that it is a problem, that they're going to have to address it in the future in the legislation, how can I put it? It encourages the wrong sort of behavior. So let's leave it there. That's the 3 new types of leave that have been added. I'll give you the effective dates on the next slide. And then coupled to that, 2 new benefits have been added to the UIA. There's only 2, whereas there are 3 new types of leave, because adoption leave has always had a benefit related to it. They've just tweaked it a little bit around the new arrangements. So the 2 new benefits are for the parental leave there and for the commissioning parental leave. And they, because there's a child involved here, are calculated at the flat rate of 66%. Credit days are not taken into account to calculate the benefit. Why? Because the period of the benefit is defined by law. It is 10 consecutive days. It is 10 consecutive weeks. It is 10 consecutive weeks. So the number of credit days doesn't come into the calculation of these new benefits. It's based on those numbers. It's a fixed, flat calculation at a rate of 66%, which is wonderful for the individuals, because then credit days are not taken into account for these benefits, and therefore they are not reduced. So the full potential value of the credit days, should there be a retrenchment down the line or unemployment, is not reduced by these types of claims. So, very much in favor of the individual. Very nice piece of legislation. The African Christian Democratic Party was focusing on family values, more time, that sort of thing. That's the legislation. I've summarized the rollout in this table. So this I'll just explain quickly, but it's there for you for later reference purposes. The left-hand column here is just giving the actual Gazette number and its date when it was issued. And then the TLAA, the UIAA, and the LLAA is the abbreviation of the legislation that was published in that Gazette. TLAA is the Taxation Laws Amendment Act. It changes the tax laws. And that law was changed because the Contributions Act falls under SARS. It was changed to say that from the 1st of March, learners and foreign nationals must contribute. The UIAA is the Unemployment Insurance Act, that Amendment Act rather, that I dealt with 2 slides back. And then the LLAA is on the previous slide, the Labour Laws Amendment Act. So those are the dates. What are the dates? That one we've discussed already. Here, the Unemployment Insurance Act was amended around those areas that I explained earlier. And all of those things were made effective from the 1st of January 2019. So you can see that learners and foreign nationals had to contribute from March 2018, but legally they were only entitled to claim a benefit 9 months later, the 1st of January 2019. The fund, being good people, recognized that there was a gap in the legislation and that was unfair. If you contribute, you should be entitled to the benefit. You paid the money, you should get the money. And the fund stood in while this gap in the legislation was unfolding. But otherwise, increased benefit value, the improvements to administration, the reduced work time benefit, all of those came into effect January 2019. And then lastly, we have the Labour Laws Amendment Act. I forgot to mention that it corrected those drafting errors that I mentioned. That was made effective January 2019. The other areas that were changed, the BCEA for the 3 types of leave, the parental leave, the adoption leave, and the commissioning parental leave, made effective from the 1st of January 2020, as well as the removal of the event of childbirth from family responsibility leave. So that's when those things happened. And then, which is part of the LLAA, it changed the BCEA and the Unemployment Insurance Act, is the benefits for parental leave were introduced in November 2019, and the benefits for adoption and commissioning leave fairly recently in lockdown time, 1 April 2020. So just remember, we have 2 things here. We have the actual leave, which is in the BCEA, January 2020, and then we have the benefit related to that leave. and that was a bit later in this case. So strangely, the benefit was available in November 2019 for parental leave, but it could not be applied because you could not grant parental leave before January 2020. So again, a bit of the cart before the horse situation. Be that as it may, I hope this clarifies this very confusing 3 years of changes to the legislation. And it's now finished. It's done and dusted. Everything is now effective, as you can see, and we can move forward from here, which I'm going to do just to move quickly to the National Minimum Wage Act. I see we're close to the hourly 5-minute break, but let me finish this and then we can take a 5-minute break. This is just to remind you, which I'm sure you're all aware of, that the national minimum wage rates, the hourly wage rates, were increased across the board, as you can see here. The various categories. The main one is a general category, where when it was introduced in January 2009, the minimum wage was 20 Rand. It's now been increased by 3.8% to 20 Rand and 76 cents. The big thing is that this came into effect on the 1st of March 2020, so at the start of the tax year. The Gazette confirming these changes were only issued, 10 days prior to that. So it was not done very nicely. There's a huge amount of changes that payrolls have to do around the national minimum wage legislation, and of course employers as well, in applying the national minimum wage changes within your organization. So I wrote to the chairman of the National Wage Commission. It's an organization that was set up to monitor the effectiveness of the national minimum wage. They've been given, from memory, I think it's 7 economic factors that they have to take into account to see if the national minimum wage is working effectively and positively. Is it ineffective or inefficient, and is it negative? And they have to measure it, which is a very good thing. They're very competent people. I think there are 12 on that board, the National Minimum Wage Commission. And at the end of doing a yearly investigation around the national minimum wage, they make a recommendation to government to say, we recommend that you increase the national minimum wage. Government makes a final decision, which they then did. And then it was published very late. So I complained to the chairman about the late publication because it affects the implementation of the national minimum wage, and he promised that it was early days first time around and he'll take it into account for next year's increases. And by the way, the National Minimum Wage Commission has the power to recommend a decrease to the national minimum wage. And it sprung to mind in this lockdown period and the serious impact on the economy, whether they are going to look at this very seriously, or obviously they'll take it into account, but whether it will result in a recommendation to reduce the national minimum wage, well, only time will tell. We're going to hear hopefully early next year, January, February 2021. But it is possible. It is within their power to recommend a reduction of the national minimum wage. So if they recommend it, it doesn't mean that government must accept it. That's the last step. And then lastly, just to say that there's weekly wages around learners, and that Schedule 2 has also been increased in line with these increases as well. And the detail of the schedule is in the notes section of the slide when you get to that. Right, just on 10:10, time for a 5-minute break. So I will see you again at 10:15. Right, everybody. I trust you can both see and hear me. If you can't, then the ANC will contact me by phone, but I trust that my camera is on and that the sound is on, and that you're all suitably refreshed, and that your spouse or partner has given you a neck rub and a nice cup of tea or coffee or something to get you through the next session, which is to do with the tax side of things. And I didn't explain it clearly in the agenda session. Excuse me, but I'm really struggling with the phone boss sinus situation down here. When you go away and you come back here down in George, there's the bowl in front of the Otanigmas, and the phone boss pollens and that are very high. So excuse me. So on the agenda, there's two sections there. The first one is where we are now, the disaster management tax relief bills, and the next session is tax changes. So this is to do with the 4 months basically that we've just gone through, April through until July, April, May, June, July. And while the period is now finished, in some cases there's been 2 extensions, which I'm going to point out to you. So it's extended beyond July. And I think it's perhaps just good to have a bit of a summary of what happened, because I think the consequences, even though this period of legislation has broadly closed, I think the consequences are going to be with us for quite some time, especially around the employment tax incentive. There's going to be a lot of consequences there, I predict. So let's just start with them. I wanted to say something else, but I'll come to that now. Good. Just as a summary, sort of a mini agenda, this is what it is about, this disaster management tax relief. The principles are that I'm only dealing here with employment-related tax relief. There are a number of other relief measures around more company tax and things like that. I'm just dealing with all of the changes that affect the payroll system and employment and employers. I'm just dealing with that area. So I'm not dealing with provisional tax, for example. So it's employment related, and ETI obviously is a big part of this relief. Broadly in principle, all of these changes or the relief could only be felt, or the benefit was only felt by tax compliant businesses. And I just want to stop there for a second just to say that I've been in a number of meetings with a new commissioner around their plans for the future. I'll talk briefly around it just now. And they are going to be placing more and more emphasis on tax compliant businesses, in the sense that they will go out of their way in the legislation, in their processes, in their support processes to help tax compliant businesses. But on the other hand, complete opposite for non-tax compliant businesses, they're going to be waving the big stick around there more and more. So they obviously, this is part of a policy, a broad thrust for the future. So keep it in mind. It's best to be tax compliant. So all of this tax relief is aimed directly at the employer. So the money, the relief in money terms goes to the employer. But obviously it assists the employer to keep going. And if the employer keeps going, then you save jobs, well, you save businesses. Regrettably, a lot have gone to the wall, but you save businesses and you save jobs. So that is its purpose. The benefit that goes directly to employees is the one that we're coming to, and that's the TERS benefit. And it's absolutely critical, because that is the one that the employees get directly. That's their financial assistance. This is for the company. So that by way of introduction. And then here you can see the sort of 7-step legislation process of the release of what are called, for short, DMTR bills, Disaster Management Tax Relief Bills. Now, remember that President Ramaphosa announced the national state of disaster on the 15th of March, and then the lockdown was the midnight of the 26th of March, if I remember correctly, or a minute after midnight on the 27th of March. Now this first bill, or the first two bills, which I'll explain now, they were issued on the 1st of April 2020, which I put it in red. So very shortly after the start of this disaster period, these bills were issued. So it makes you realize that obviously long before the announcement by the state president, you know, the process of managing South Africa through this difficult period of COVID-19 had been discussed, because you don't get bills of this nature released in legislation drafted between the 15th of March and the 1st of April. It takes some time, but that's what happened. The DMTR bill was split into two areas, really. You have an administration bill, which changes things in the Tax Administration Act, and you have just the bill, which changes all of the other areas of legislation, the Income Tax Act, the Fourth Schedule, Unemployment Insurance Contributions Act, the Employment Tax Incentive Act, as we see, which also falls under SARS. Now, you know, what's really significant, so these were the first two bills, but issuing this on the 1st of April, and they were deemed to be effective on the same day. So, you know, this is just an unheard of situation. Payrolls and employers, you know, had to then apply what they were seeing for the first time on the same day, which obviously is impossible. So we all were paddling the same canoe, along with National Treasury and SARS, who were under huge pressure to try and make the aspects of these bills work. And part of the aspects of this bill here, where I am now, this is the substantive bill, was employment tax incentive. So very, very difficult. This was followed exactly a month later by another set of bills, also an admin bill and the substantive bill, on the 1st of May 2020, that deemed some things to be retrospectively effective, and other things from the 1st of May again. So again, hugely problematic. Perhaps I must just pause here for a second, and SARS were very kind to explain this to me, because normally, as far as payrolls and employers are concerned, you don't want to have legislation being changed and being changed retrospectively back in time, because it means in a payroll which is running weekly and monthly that you are complying with the current law, and then suddenly in the future they change the law under your feet, which you've been applying previously to that. So over the years, the Payroll Authors Group has managed to make this happen, that they always change the legislation ahead. So you'll see with the tax bills coming that the changes are scheduled for 1 March 2021, which gives you time to prepare, and which is why we have these sessions. You can see what's coming, you can start thinking, you can prepare. So I asked SARS to explain to me how they can make a bill that hasn't gone through that cycle that I explained to you earlier of consultation, comments, Standing Committee of Finance, so how they can make it effective on the day that it's released. And they said that there's a difference between retrospective and retroactive. And in terms of making something retroactively effective, which is what they did, as long as the provisions, the requirements of that legislation are clear, and they did a pretty good job of making it clear. There's an explanatory memorandum which is not on the list here, but as long as those requirements are clear, then legally, if I can use that term, they can make this legislation retroactively effective, which is what they did on the 1st of April 2020. retrospectively effective, not a good thing. So yeah, the bottom line's the same. It was still very difficult. So here we had a revised 2 bills, the 1st of May, with, you know, one retroactive date of 1 April there and here. Then on the 19th of May, so the 1st of May was followed very swiftly by a 2nd bill. And bear in mind that each one of these bills replaces the previous one. Okay, they're not on top of, they are replacement bills. So then the substantive bill was issued, which made some changes retrospective to the 1st of April, which was a problem. It's around ETI. And this is broadly what we've been running with this bill since then, until on the 24th of June, they issued final bills. This is around the same time as the revised budget period. And these 2 bills here, the admin bill and the substantive bill, are now swiftly moving through the National Assembly and the National Council of Provinces towards promulgation. What has happened since then, and this is in the last 2 days, is SARS kindly informed me that there are 2 aspects of this bill on the 24th of June, which has been changed literally at the doors of Parliament. And I'll point those 2 changes out as we go through. So there is going to actually be another 2 bills issued which incorporate the 2 changes that I'm going to be talking about. So yeah, what can I say? Dear Makar, a lot of pressure for everybody. I think Treasury and SARS did a pretty good job. Payrolls were under huge pressure, employers were under huge pressure. That's the background. Let's just have a look at some of the measures. Let's start with the Solidarity Fund, which was a government-sponsored, government-organized fund. And just a few points about it. And it was quite widely pushed and promoted and advertised, if I could use that word, to encourage citizens of the country to, you know, donate money to these funds, to this fund, which would then be used for general assistance, the people who are really struggling, the low-income people. So this fund it's a PBO, public benefit organization, and it is approved in terms of Section 18A, and Section 18A allows donations to these organizations to have some form of tax relief. Okay, it also governs the affairs of the fund itself, but we're just really looking at the donations. And all of these types of funds, Section 18A, including the Solidarity Fund, there is tax relief in the payroll. In other words, the balance of remuneration on which pay as you earn is calculated is reduced if there's a donation, and there is a similar calculation done on assessment at the end of the year. So the current donation thresholds, deduction thresholds for tax are specified. When I say current, this is outside of the special period, and this is for all Section 18A approved funds in general. Okay, I'll come to the Solidarity Fund now. But there, briefly, in the payroll can allow, if there's a donation, they can take that donation, allow it as a deduction up until 5% of the balance of remuneration. Whereas on assessment, a bigger amount, a bigger percentage is allowed, 10% of the equivalent concept of balance of remuneration, which is taxable income. So the reason why there's a difference is SARS were just cautious in the sense they don't want to give too much pay-as-you-earn relief in the payroll in case it doesn't fall within the 10% on assessment. And remember, taxable income, while it's similar in concept to the balance of remuneration, taxable income, you know, takes other things into account. There can be other streams of income that are included there. There can be other forms of deductions allowed. So that's why there's a difference in those 2 figures. So that's what we've had and still have, incidentally, for all Section 18A approved funds other than Solidarity. Solidarity was given a much higher deduction threshold, which will apply for this tax year 2021. And as far as income tax is concerned, there's an additional 10% of taxable income that can be allowed as a deduction. So in other words, this is on top of that 10%. It means that if the employee only donates to the Solidarity Fund, that the deduction threshold that's taken into account is a maximum of 10 plus 10%, 20%. If the employee also donated to other Section 18A approved funds, the SPCA, child welfare, those sort of organizations, then those donations to those general funds would fall into the 10%. What was left, let's say there was still 5% was used, 5% was left, that 5% could then be applied on top of the 10%, so 15% available for the Solidarity Fund donation. So I hope that explains quite a confusing process to you. This additional percentage obviously is only available for this tax year. As far as payrolls are concerned and pay as you earn, it's more specific. The period is 4 months, April to July, but they allow the donation outside of that period. So you can see that the payroll, specifically for Solidarity, can apply a deduction threshold of 33.33% for 3 months, or mathematically equivalent 16.66% for 6 months. Now, I got a ruling from SARS on how to apply these two options in the payroll, and the ruling came back very clearly that it is the employee who's making the donation who has to choose whether they want to apply the 33.33% for 3 months or the 16.66% for 6 months. Having made the choice and that box is then ticked in the payroll, it cannot be reversed. So you can't flip-flop between 33.33% for 1 month and 16.66 and backwards and forwards and so on. So that is how they are applied. And of course, you know, the assessment process is the final calculation because this is quite difficult. There is a tax certificate code which payrolls then must apply to the donations, to the Solidarity Fund code 4055, and in the validation rules which SARS set up, which payrolls have to take into account when we develop our solutions, SARS will be validating these amounts or percentages there. So, you know, we've asked, and you know, you don't get replies on these things. We just asked that they treat these validations with a fair amount of sympathy, in the sense that they provide a little bit of leeway, because this wasn't easy to put into effect so quickly, and there can be a few ups and downs there. So, as I say, they don't confirm that they're going to do this, but I trust that they will. Right, that hopefully explains the Solidarity Fund. Then we get similar organizations called COVID-19 disaster relief organizations, which I've shortened to be DRO, C19 DRO for the purposes of the slide here. Now, here is one of the places where the period has been extended. Broadly, these organizations, for example, the fund set up by the Oppenheimer and Rupert families, R1 billion each, and the purpose of these funds is to support SMMEs, small organizations, because arguably they suffered the most during this period. So again, donations are allowed the general deduction that I spoke about earlier. The period initially was 4 months. April until June, April, May, June, July, until July, and it has been extended by 2 months until the 30th of September 2020, when all of the rules on the slide will apply until 30th of September. So it's a 6-week period. Now, the principle around the support to the SME is that the SMME can apply to one of these funds. There are quite a few of them. Obviously give some financial details. It is approved in the sense of a loan being made to the SMME at very preferential interest rates and repayment terms. I can't remember the details, but repayment over 2 or 3 years at very, very low interest rates, but it is a loan. Now the process is that the DRO pays the weekly allowance directly to the employees of the SMME. So obviously the SME's payroll would advise the COVID-19 DRO of the employees. The money would be paid directly to the employees, but then the DRO advises the SMME of the weekly allowance, as it's called. I'm going to come back to that now, of the weekly allowance that has been paid to the employee, so that the SMME can see, well, my employees have received this weekly allowance to assist them. However, these weekly allowances accumulate and form a total loan amount, which the C19 DRO has to repay, as I say, under preferential interest rates and repayment terms. So that's a broad principle. Now, as far as the administration and in a little more detail, the way I understand it, incidentally, I don't know that this is being widely used because we haven't received many queries about it. Perhaps it just works very well and there weren't queries. But be that as it may, my understanding is that the weekly allowances, as they're called, that the DRO advises back to the SMME must be processed in the SMME's payroll so that it's on record. Then in the SMME's payroll, that weekly allowance, the gross remuneration value, I just use the word gross in brackets to illustrate that it's before deductions, the payroll then calculates UIF and ETI. So the SMME can still benefit from ETI during this process, even though the money is effectively paid directly by the DRO. The SMME is still liable and can benefit, liable for UIF and benefit from ETI. However, the weekly allowances are specifically by legislation excluded from the balance of remuneration. So the weekly allowances are included in gross remuneration for those purposes. They are excluded by law from the balance of remuneration. And the balance of remuneration is used to calculate pay-as-you-earn and the skills development levy. So there will be no pay-as-you-earn calculated on these weekly allowances, okay, which is significant because these weekly allowances are income and they must be declared at the end of the tax year on the annual return by the employee. And they will be then subject to income tax depending on thresholds and things like that. And there is a tax certificate code which the SMME must then put into place and report these weekly allowances. And the employee, just to repeat, must declare this income on their annual return. So, you know, that can lead to a bit of financial hardship, assuming that the individual is then assessed for income tax at the end of the year, and there was no pay-as-you-earn calculated because there was no pay-as-you-earn by law and no skill development levy. So, you know, something to really to bear in mind as far as this whole process is concerned. And then lastly, a significant part of this is employment tax incentive. Now, for those of you part of employment tax incentive process, you will know that there are 7 tests, qualifying tests. In other words, there are 7 tests which must be met, all 7 of them, before the employee qualifies to generate the benefit of the employment tax incentive for the employer. So the employer gets the benefit of the ETI, but it is based and calculated around the concept of a qualifying employee. And there's 7 tests which must be ticked, met, before the employee qualifies to generate that ETI for the employer. Now, one of those 7 is the minimum wage must be paid. And the problem is that this amount of money paid by the DRO to the employee was given the term weekly allowance. Now, when you look at minimum wages, you're looking at the National Minimum Wage Act. You're looking at the concept of wage, and the Employment Tax Incentive links the concept of wage in the ETI Act to the definition of wage in the Basic Conditions of Employment Act. So we're looking at the labor law concept of wage here. And we're going to deal with this a bit later again. But both remuneration and wage in labor law terms does not include the concept of an allowance. An allowance is the amount of money in labor law terms which is paid to allow the employee to work. For example, the transport allowance is paid to allow the employee to get to the building site or to the farm to do the work. And then they are paid remuneration for the work done. So there's a difference between money paid in respect of work done, which is remuneration, and money paid to allow the work to be done, which is an allowance in labor law terms. So if you look at the form, the term, the words, this allowance is not wage, because in labor law concepts, allowances are not wage, they're not remuneration. However, and again, I went to SARS for a ruling on this, and they came back and said, but what is this weekly allowance? It's called an allowance, but what is it? What is the substance of it? Not the form, the term, the substance. And I suggest to you that you would have to look at what this weekly allowances is replacing. When I say you, the SMME, if it's essentially replacing what their wage was, then I think in substance the weekly allowance could be seen to be a wage. But that is going to vary from employer to employer. One must look at the specific circumstances for that employer. If one can then make a reasonable assumption that the weekly allowance is a wage in substance, then that amount can be used in the ETI calculation to determine whether the employee qualifies to generate the ETI for the employer. So fairly complex. I hope that explains it. As I say, as far as I know, because there haven't been many queries, I don't know how widely this has been used. I suppose we're going to see the statistics around all of these things in 3 months to 6 months time. And it'll be interesting to see how well certain tax relief measures, etc. Hopefully we never have a repeat of this, but it'll be interesting. Good. Let's move to the next slide. And this is the deferral of the employer's pay-as-you-earn liability. So we here on the MP201, and the normal situation of the employer declaring the pay-as-you-earn, the skills development levy, the UIF, and ETI if there's ETI, and then whatever the liability is has to be paid across to SARS on a monthly basis. So this is a deferral again to help employers where only the pay-as-you-earn could be reduced by 35%, and the balance of 65% is then paid across. So there was an initial period in which this could happen, and I hope I've illustrated it clearly. This is the second of the late changes at the doors of Parliament. So the period of deferral up to a few days ago was a 4-month period. So it gets a bit confusing. I just made it clear. It was from April. In other words, it takes effect by the MP201, due date 7 May, and ending July, which is the MP201 due 7th of August. That was the initial period. It's now been extended by 1 month. So it still obviously starts there. It now ends a month later. So this 35% is going to continue for a month longer than planned. Okay. Now, being a deferral, this is short-term relief. It has to be repaid, and the repayment conditions was to divide whatever the total deferral amount was over this period, divided by 6, and it must then be repaid in 6 installments, equal installments. And by the way, we've just got clarification from SARS that I'm not quite sure how this is going to work on the payment process, part of the MP201, but you have to use the same reference number for this installment payment as what you used for that specific MP201 for that month. So the same reference number is used. I trust that SARS hopefully will make this clear in the process of the repayments. Remember, by the way, this is also optional. You didn't have to take this 35%. So it's only for those organizations that did make use of the deferral of 35%, which must then repay. So it still has to be repaid over a 6-month period. So that principle stays the same. It just starts a month later and it ends a month later. So it comes to an end by the MP201 due by the 7th of March. Right. Then, as far as the skills development levy is concerned, I hope this is straightforward. There's some confusion in the beginning. This is not a deferral of the liability to be paid. This is a payment holiday. There's no repayment here that is required. So, of course, skills development levy, the principle, of course, is that if you're registered as a company or a sole trader or a trust or whatever, CC, for pay as you earn, and if your forecast annual remuneration figure 12 months ahead exceeds 500,000, you must register for the levy and you must pay 1%, not of remuneration, of the balance of remuneration. Broadly the same figure that pay as you earn is calculated on, with some exclusions. So that's the broad principle. So a 4-month payment holiday was declared by the DMTR bill, and it started again from May, which is in effect by the 7 June MP201, and ended and still ends the end of August. This payment holiday has not been extended. These periods are the same. So, you know, our advice to payroll suppliers, this is no history, but it would be fairly simple for the payrolls just to change the 1% levy calculation percentage to 0% for that 4-month period, that the payroll goes through the same processes, that it still reports on financial reporting out of the payroll. It will just be a zero amount. So that would be easy. And SARS did the sensible thing. They froze the skills development levy field on the EMP 201. In the case of, you know, employers doing this manually, or just inadvertently forgetting about the payment holiday and paying. So, you know, that prevented those sort of issues. And just to repeat, this is a holiday. There is no obligation to repay. The Department of Higher Education, incidentally, we're not very happy about this at all. And in the submissions around these bills, they had a long submission putting their financial position, because they will not be getting this income for 4 months, which is funding, you know, the skills levy process for the SETAs. So that request by the Department of Higher Education was not accepted in the process. So it remains unchanged as it is here. Good. Now we get to a really difficult area, which is the employment tax incentive relief measures over the same 4-month period, April to July. I have summarized the relief measures because it is past tense, it's history, just on one slide. Previously, when I've dealt with it, I went into the calculations, and it's a 4 or 5 slide matter. So I've summarized it here. Now, in my opinion, this is a particularly valuable tax relief measure, this enhanced ETI relief measure, as it's called, the enhanced ETI relief measure. Because it is quite significant in the scope of the enhancement, which I'll explain now. There's a lot of value in the enhancement to the ETI amount. So if you were not part of ETI as an employer in the past, I recommended when doing webinars on this in the early days of April that companies, do get involved and become part of ETI. So what the enhanced relief comes down to is there are 3 areas of change. The first area is around the qualifying tests, which I mentioned earlier, the 7 qualifying tests for the employee. And the first area is that of age. The normal ETI legislation focuses on the age group of 18 to 29. That conceptually is a young person for the purposes of the employment tax incentive. These are the people who are, not employed. They're trying to encourage employers to employ people of this age category to give them work exposure, and hopefully they get into the system in that way. So this was how the previous legislation read. It remains like that. It's unchanged in the enhanced provisions, and the ETI is only granted for 24 months in which the employee qualified, 24 qualifying months, and it's 50% of the wage for the first 12 months and 25% of the wage for the next 12 months. So again, it's tax foregone for Treasury. They're giving up tax to encourage employers to employ young people. That's the value exchange. So what has been added on as new is that these 18 to 29-year-olds who have completed the 24 qualifying months and therefore no longer qualify, they qualify again during this 4-month period. And then there's a broad age group which has been added on to the 29-year ending date, and that is 30 to 65 years old. So that is a significant increase to the number of employees who qualified for ETI during the 4-month period. Then the second change is also significant. To qualify, the employee, the youngster, had to have been employed on or after the 1st of October 2013. Otherwise, that person didn't qualify. Now, this 1 October 2013 date was taken out of the legislation during the 4-month period. So in other words, it doesn't matter when the employee was appointed, before or after October 13, that test was not applied at all for qualification. And then as far as the money is concerned, generally the ETI value was increased from 500 Rand to 750 Rand. There was generally an increase of 250 Rand. I'm just simplifying this because it depends on sliding scales and things like that. But broadly, there was quite a significant increase in the value of the ETI amount. So the number of qualifying people to generate the ETI increased hugely, and the value of the ETI to that huge pool of people was increased as well. So as I say, very valuable. All of these rules here have already been reversed, and the old ETI rulings, conditions, provisions are reinstated. They apply again from the 1st of August, just like they applied up until the 31st of March, prior to the 4-month period. So we're back into normal ETI rules at the moment. Now, I don't want to go into too much detail, but these changes were sprung on us on the 1st of April and effective from the 1st of April, as I illustrated earlier. We got to the 1st of May with the next round of bills, and they retrospectively made changes around the value of the ETI amount, and they made it retrospective back to the 1st of April. So Payroll's only heard about it during May and had to retrospectively calculate back into April. And ETI in principle is a monthly administered, a monthly calculated piece of legislation. You do the calculations, the process, the claiming on the MP201 in respect of April, shall we say, and April is done. And payrolls have to report what happened in April on the tax certificate. You don't see it, but there's information in the file that goes to SARS per qualifying employee per month. So that's how payrolls were designed and programmed. Now suddenly we had to bring in a retrospective effect. In May, we had to change what had already been calculated in April to reflect the May law and make all of these things gel and fit together, including the monthly tax certificate reporting. Now, to say that this is a huge task is not giving it, proper emphasis. It was hugely problematical. It was big changes. It changed in some cases, depending on the architecture of the payroll, it changed it dramatically. And when you change the architecture of the payroll dramatically, the wheels can fall off very easily and problems can happen. And remember, while this is all happening, the payroll has to report monthly information to SARS. And it can easily be, and I'm sure will be, that particularly in the early months, that information on the tax certificate going to SARS is not quite right. And remember that SARS uses the monthly ETI information from the tax certificate for compliance purposes and looking at refunds for ETI and things like that. And we are obviously, now at the end of the first 6-month tax certificate cycle, March until August. We have to submit tax certificates, and those tax certificates will contain the ETI information which has been calculated over this period. So again, I made a formal application to SARS to say, be aware of the pressure that payrolls were under. With the best will in the world, it was difficult to get these things spot on. This can reflect on the tax certificate information, which in turn will reflect on your compliance processes. So, to summarize it, it's an appeal for sympathy for employers and for payrolls. And again, SARS will not commit on these things, understandably, but I think the message has got through, and hopefully we are going to see some sort of sympathetic handling of these things in the future, because the process has now ended, but the effects are still going to hit the fan, if I can use that term, at a later stage. The one thing we had to change in payrolls is we had to give an indication per month. Remember, this is monthly information to SARS of whether this information is enhanced tax relief. So we had to indicate to SARS for that employee, this is enhanced tax relief, so that they can do their checks a little bit better. So that's to assist SARS there. But yeah, very valuable. Due to the pressure and the time frame, difficult. But I hope that there are many employers and indirectly the employees who benefited from this measure. Good, let's now start looking a bit into the future. What I'm talking about now are proposals made in the budget 2020, the 26th of February. And those proposals, as I said earlier, are translated into legal language by the drafters of legislation, and they appeared in draft bills on the 31st of July. And I'm just going to talk about those aspects which impact on employers and payrolls. But it is now 11 o'clock. So again, it is time for a 5-minute comfort break, and I'll see you at 11:05. Right, everybody, welcome back. Just to remind you that the section that we've just completed was a little bit historical in the sense of it was the tax relief over the past 4 months, which has ended, but the consequences are still going to be felt. And in cases the period has been extended, as I showed you earlier, the deferral period, for example, has been extended beyond the 4 months. So where we are now is we're looking ahead. We're looking at the proposals in the 2020 budget of February to change the law. And as I said, those proposals lead to draft legislation, comments, Standing Committee of Finance, promulgation, Parliament, etc. So that's what we're looking at now. So we're looking ahead. Also looking ahead, there are 2 sections left to deal with here today. It's this section that we are now, followed by the UIF TERS, just a bit of a follow-up and summary of where we are there. And I hope to be able to complete those coming 2 sections by 12 o'clock. We can take another 5-minute break then, and then whatever questions you might have, the ANC have been consolidating them in the background, and in that 5-minute period then, I will get to have a look at those questions and deal with them after that. So that will be in the period then from about 10:05 until closing time. Good. That's the plan. Let's just have a look at the few things that have been proposed to be changed. This is quite an easy one, just for clarification. Remember that the concept of business travel, being away from your usual place of residence for at least 1 night for business purposes, normally the expenses related to that business trip is compensated for by using the subsistence allowance procedure, which, by the way, in my opinion, is a very good mechanism to do it, as long as you pay up to the deemed expense thresholds. It works very simply, very smoothly. I think it's a great process. So that is the way you compensate an employee for meals and incidental costs incurred during a business trip. Remember, the hotel is paid for directly by the employer. If a night is spent away from home, at least 1 night. If, however, there's a business trip and a night is not spent away from home, then by law you cannot apply a subsistence allowance for that day trip, as it were. And obviously the employees have expenses on the road. They have meals and incidental costs on the road, Coke and meat pie at the cafe and so on. And it's a business trip, and one would expect that in some way the employer must compensate the employee for incurring what are actually the employer's expenses. So it's always been a little bit problematic. The way to do it is a reimbursement, and a reimbursement requires instruction from the employer. So the employer must say, I instruct you to go out on today's business trip. I instruct you to eat a meat pie at the cafe, and I instruct you to bring back the slip from the cafe so that I can reimburse you for the meat pie at the cafe. You can appreciate the cumbersome process involved in instruction going right through to reimbursement at the end. So if it is a true reimbursement, there is instruction, for example, then that reimbursement is tax-free. It's a business expense and the employer is picking up the tab. However, if that chain is broken, then in legal terms, that reimbursement is taxable. The employer must be taxed on it. So this was a huge problem, and the change proposed here is that the instruction part of this process falls away by putting it into the employer's policy, and the employer's policy around business travel would then say that we will reimburse. We are not going to give you, for those meals and incidental expenses, we are not going to give you daily instruction. The instruction is incorporated in terms of the proposed law in the policy. So that takes away that aspect of the whole thing. But there is a little add-on to the proposal, and that is that the reimbursed amount, for example, a meal, cannot exceed what are currently the daily subsistence allowance amounts for meals and incidentals. So one must just bear that in mind. And this is then obviously a much smoother process. It's still based around a reimbursement principle and not around an allowance principle. Okay, the allowance principle applies for one night spent away from home. So a little bit unfortunate. One would have thought maybe they could have come up with a day trip allowance amount, which would have taken away the paper aspect of the reimbursement, but there it is. Maybe it's a step down the road. Right, then we have a significant change, important change around bursaries, around employer-provided bursaries to the relatives of employees. Now, this is quite a huge subject. Let me just try and summarize it. That currently and for many years, in particular since 2006, if the employer has a bursary policy and the bursaries are bona fide bursaries, it's in respect of studies and skills upliftment, and they are granted either to employees directly or to the relatives of qualifying employees, those who earn less than 600,000 a year. Relatives of employees, by the way, defined to be those who fall within the third degree of consanguinity, which means you put the employee in the middle of a picture. You go up 3 levels, so that's fathers, grandparents, great-grandparents would be within the 3 levels of consanguinity going up. Going sideways, you go to brothers, sisters, ooms, uncles, cousins, Kentucky hillbilly cousins, I don't know, going out three levels sideways, and then going down where it's mostly applied, you have the employee, and then that employee's children, grandchildren, and great-grandchildren are relatives in terms of the bursary requirement. So the employer, by policy, by choice, can provide bursaries within that frame, and that would be the relatives. Now, subject to certain rules and monetary limits and so on, if the employer pays for something that the employee should pay for, again, it's in the employment environment, it's a benefit to the employee that the employer pays for the schooling for the children, and that benefit translates in principle into a taxable fringe benefit. However, going back to 1992, to encourage skills upliftment in the country, to encourage employers to assist in the skills upliftment process, these very beneficial bursary exemptions were put into place. So instead of the fringe benefit on the payment of the school fees by the employer, there's an exemption of either the full amount or part of the amount, which then assists greatly for the parents and the education of the children, which, as I say, is where it's mostly applied. So that's a broad principle. Now, between 1992 and 2006, in terms of the relative exemption of the fringe benefit in respect of relatives, if there was an element of salary sacrificing, then that exemption fell away. Now, when is it a salary sacrifice? I must maybe deal with it at this early stage, and it's not possible to deal with it thoroughly. But broadly, the viewpoint of SARS around when is it package restructuring and when is it or legitimate package restructuring and when is it salary sacrificing is broadly that SARS say that you cannot reduce accrued remuneration. In other words, remuneration to which there is a legitimate expectation. they say you can't reduce that because, you know, if there's a legitimate expectation that money is taxable, no, you're reducing it, so therefore they see that to be a salary sacrifice. Also, they say that if you reduce the employee's salary, and if you don't reduce everything else that is linked to that salary proportionately, and yeah, obviously we're talking about possibly medical scheme contributions, retirement fund contributions. If the salary comes down, then the contribution to the retirement fund must also come down. So you can't, you know, pick the best of both worlds here. It has to be aligned. So there are other elements of salary sacrificing that on audit that they will look at. It's a hugely complex area, but that's broadly the main areas, what determines a salary sacrifice. So in other words, to apply a bursary for the relatives of one of your employees, it would be best to do it in the future, to say, look, we're not going to reduce your current salary to which you have a legitimate expectation, but we know that next year you should get an increase, or we know that there is, you know, an expectation of a bonus. Therefore, looking ahead, we can reduce those amounts because they have not yet accrued and replace it with a potentially exempt bursary. So just to broadly explain, you know, the concept of salary sacrifice and the way that SARS's view on it. Yeah. So I digressed a little bit. The exemption for the fringe benefit for the relatives was not allowed by law from 1992 if there was seen to be an element of salary sacrifice. The employees, the mother or the father's salary was reduced illegally and replaced with an exempt bursary. Then, to further encourage skills upliftment in the country, which is not going well, as we all know, from 2006, they removed from the law the element of salary sacrifice. It was removed. So in other words, even if you sacrificed the employee's salary, you could do it without legal consequences up until now. Now, the problem is that this removal has been abused. Too much advantage of it has been taken. There are a number of bursary schemes that have flourished over the last 6-7 years that I've been aware of, which are doing things in the wrong way, if I can put it to that way. So this got up SARS's nose, and they said, no, we can't have this. This is an abuse of the situation, and they are reverting to bringing in the salary sacrifice restrictions around bursaries granted in respect of the relatives of the employee. This doesn't affect bursaries in respect of employee bursaries. It's the relative bursaries. So what they say is that bursary for the relative, for the child of the employee, can only be exempted if the bursary scheme is what's called an open bursary scheme. Open bursary scheme means that the bursary is available to all, not only to employees, it's open to individuals outside of the employer, outside of the employment relationship to apply for that bursary. Okay, you get closed bursary schemes, which are closed just to the employer, and open, which is open outside of it. So to be able to apply the exemption, the bursary must be an open bursary. Okay, now I'm not an expert on writing bursary contracts and so on, but this obviously is going to mean changes to the process and to the concepts and the policy. And then secondly, they just say that the exemption is not allowed if the employer's remuneration is salary sacrificed. Okay, as I explained earlier. Also, they've gone a step further and they said, bearing in mind that the employer is incurring an expense in paying the school for the child's education, that expense in the employer's hands is deductible. that expense will no longer be deductible again if there's an element of salary sacrifice. So this is going to hit the employee in that it will be taxable. It will hit the employer in the sense that it will no longer be tax deductible. So it's hitting on both sides, okay? Which just tells you how valuable a bursary was in the past, because the children were possibly getting an education or better education than normal as a result of the bursary, so they benefited. The whole family benefited. The employee benefited by virtue of the exemption to the fringe benefit, and the employer benefited by having, firstly, happier employees, and secondly, by having a tax deduction in the company's hands. So it's a wonderful thing, but they're just tightening up on the salary sacrifice element. Now, the last thing is the effective date, 1 March 2021, and I'll put the 21 in red because the initial proposal was retrospective, 1 March 2020, and I reissued my retrospective complaint letters to Treasury and so on, said, can you please not do this retrospectively? It impacts on the payroll, it impacts on employers. Can we do it ahead? And it is 1 March 2021. So you have got time to look at your schemes, to make sure that you don't salary sacrifice, to maybe move to an open bursary scheme instead of to a closed bursary scheme, particularly for bigger organizations who still want to assist the children of their employees. Because if you do that, then all of the benefits of the bursary remain. The exemption for the employee, the education for the child, the tax deduction for the employer. And this, as I said, gives you time. I hope that explains it. Let's move on. And here's a fairly minor one around employment tax incentive. Let me try and be brief on this because we've got quite a lot to do with TERS that's coming up. If you're part of the ETI process, then the way that it works is that the payroll calculates the ETI total for the month based on the qualifying employees in the payroll for that month, gives a total to the employer for that month. The employer puts that total ETI onto the MP201, and the pay-as-you-earn liability, shall we say it was 100,000 Rand for the month, and the ETI is 60,000, then the liability is reduced by 60,000 and the employer only pays 40,000. Okay, that's the normal course of events. The ETI, in other words, is less than the pay-as-you-earn liability. However, it happens with flat remuneration structures that the ETI can be more. So, for example, the pay-as-you-earn liability is 100,000, ETI is 120,000. What happens is that the ETI reduces the pay-as-you-earn liability to 0, so the employer pays nothing. But the 20,000 that could not be set off against the pay-as-you-earn, because there wasn't enough pay-as-you-earn, is rolled forward to the next month. And if that happens in the next month again, the total is rolled forward to the next month. And so it can roll forward for the 6 months of the tax certificate cycle, which is March to August, the first cycle, and then September to February, the second cycle. At the end of that tax certificate cycle, then the amount that's been rolled forward will be refunded if the employer is compliant. Tax compliancy, you must be up to date with your taxes payable to SARS, all taxes, and you must be up to date with all returns that has to be made to SARS, with respect of all taxes. If you're not tax compliant at the end of the 6 month period, then you lose that amount which you couldn't claim during the 6 months. However, that's for compliant employers. However, the law was a little crazy. If you're not compliant at the end of 6 months, then you didn't lose that potential refund. It was carried forward into the next period, and if you became compliant 3-4 months down the line, then the law actually said that you're then entitled to the refund. So this is obviously favoring non-compliant employers as opposed to compliant employers. And that's certainly not the direction that SARS want to go in. So they are going to change it so that non-compliant employers at the end of the 6 months are treated in the same way as compliant employers. Okay, so I hope that explains it. Good. This is one of those change the law by removing 2 words, which is a small change but a big consequence. And it is to do with tax maladministration, potential penalties, potential interest, and those sort of things. Now, any offences, as far as pay as you earn is concerned, is dealt with in paragraph 30. And if the incorrect procedure or whatever was done was both willful and without just cause. In other words, whatever went wrong was done deliberately, willfully, with intent, and there was no good reason for doing what you did, then, you know, the hammer comes down on your head and the employer's head, and there's penalties and interest and all that sort of thing. So the intention is in the tax administration admin bill is changing the 4th schedule to remove the words willfully and. So those 2 words are gone. Okay, so if you do something without just cause, I think I'm explaining this the wrong way around. The onus of proof for SARS to impose a penalty and interest is there must be both intention, willfully, and no reason. Both and. Okay, I explained it wrongly. They're taking away the intention. So if something goes wrong in the payroll administration and there's no good reason, if these words are gone, then potentially that individual can be prosecuted, can be followed up. Penalties, interest, leading to even to criminal prosecution, which obviously has a huge impact on that person's life. So both from the tax practitioner side, I know I've been speaking to SITE, for example, a lot, and they, you know, are not happy about this at all. Tax practitioners will be affected by this, and they are proposing that this doesn't happen. And in our comments from the PAG on the draft bills, which I did on the 31st of July this year, we also said that we feel that this is too harsh, that a payroll administrator can end up, you know, being a criminal as a result of a sort of a common unintended error. It doesn't seem to be correct. It doesn't seem to be fair. So just to point this out to you, I think this has got there's a lot of water to flow under the bridge here. It's got a long way to go. And we'll see what happens. There's obviously reason why SARS wants to make this change, because this is in the Administration Act. It's around tax administration. And yeah, we'll see what happens in the Treasury virtual workshop, which, by the way, I'm attending next week, the 9th of September. Good, so that's just to bring that to your attention. Lastly, just to say a few words about this long-term project, which is to modernize, simplify, make more efficient, less costly, etc., the tax administration processes. So these would be all of the tax laws that fall under SARS, which there are a lot. The main one, of course, is the Income Tax Act, 4th schedule, you know, VAT, company tax, and so on. But there are royalties and etc. ETI is another big one. So the broad principle is that in the next 4 to 5 years, which has already been extended a bit because of the lockdown, which nobody anticipated, but in the sort of 4 to 5 year period, they are going to be making significant changes both to the law, the legal framework, and then to the administration procedures around PIT, personal income tax, and pay as you earn, which is the payroll area, with a view to modernizing it, etc. making it easy to understand. If you understand it better, compliance is better. Easy to administer, less costly for everybody, SARS and the employer and the payroll. So you can just see some of the points that they have raised here. Accurate and timely withholding. This is pay-as-you-earn withholding and paying across to SARS. In a briefing meeting in February this year, and I can't remember, and I can't repeat anyway, but there are huge amounts of payments, withholding payments that should be going to SARS, which are either being delayed for a short term beyond what they should be, or even for longer periods of time. A lot of money, okay? The administration to cut the red tape, to make it simpler, to make the systems better. There's going to be a lot of work being done around e-filing in particular, I think, and easy file as well, and maybe other systems too. So that will get better, simpler. For the employees, there's going to be facilities for employees to be able to see what's happening around their tax affairs during the year, sort of on a month-to-month basis. So you see, as soon as I say that, and this is certainly not on the table at all, it's just my thinking. If instead of having tax certificates submitted twice a year in the 6-monthly cycle, if there was a reduced tax certificate that was submitted every month, can you imagine the impact on everybody? It will significantly simplify the reconciliation process, which we do over 6 months. It will just be, it's just an ongoing reconciliation every month. It will help SARS. Can you think for policy perspectives as well from National Treasury and SARS, they'll be getting monthly information in, which is going to give them valuable information about taxes, projections for the future, employment, how's it going with employment, etc., which you see those sort of figures coming out in America. So massive improvements if we can get to that stage. And remember, payrolls and employers declare what's essentially a reduced tax certificate to the UIF on a monthly basis. So if we're doing it for them, we can do it for SARS as well. So yes, I'm hoping for big things in that area to make life better for all of us. Yeah, and that spins off into the annual return process. They, you know, this what did they call it now, which they've just introduced, the interim assessment, I think it was called. We're going to be seeing more and more of that sort of process. So employees who have a simple remuneration structure, you know, should have a simple life in terms of tax. That's where we're heading to, which in turn can spin off into remuneration structuring. And, you know, why are we doing all these things in these structures, which might come back to the legal framework. So you can see, you know, there's a lot here. Right, let's leave it there. I'm personally very hopeful and very excited about this. The last modernization around pay-as-you-earn was, of course, for the introduction of Easy File. I think that had a huge positive impact. There were some bumps in the road along the way, but it had a huge, and this is the next major step up, and it has been put into place as a result of the Nugent Commission, which, how shall I put it, which put a stop to, you know, the lack of development within SARS over the 4-year period prior to that. Let's just leave it there. Right, good things to come. Lastly, just to say that what's called the annuitization of Provident Fund payouts is, I can almost say with absolute certainty, is going to happen from the 1st of March 2021. Now, this is not a budget proposal. This has been an ongoing process since March 2016, and the law has already been changed, and I'll explain it briefly now. The law has already been changed. It's in the Income Tax Act, and the Income Tax Act has an effective date of 1 March 2021. Now, when I say this should happen, you can see that the law was changed to be effective from 1 March 2018. There were objections from the Labour side. It was postponed for a year. It was postponed for another year. And it looks like it's now going to happen, that it won't be postponed again. Because to postpone it, they just changed the law to give a new effective date and postpone it by another year. And maybe these proposals were to do with the social security issue. But anyway, we're at the stage where it's going to happen. Remember, the retirement reforms introduced in March 2016 had 3 broad purposes: to standardize the tax rules and the administration rules between the 3 retirement vehicles that we have: pension funds, provident funds, and retirement annuities. Prior to March 2016, each type of retirement fund had its own rules. Now we have one rule fits all. It was put in place to encourage employees to save. There was higher deductions. There was more tax relief around contributions to pension funds. And then the aspect of preservation, to encourage people to leave their retirement savings until you retire. There's significant tax differences between taking it out early and leaving it until you retire. So those were the 3 pillars that retirement reforms were based on. And then at a very late stage, around the harmonization or standardization of the rules, excuse me, where the rules before March 2016 said that as far as payouts were concerned, that the payout from a provident fund was paid out as one single lump sum, whereas pension funds and RAs, as you probably all know, broadly speaking, whatever the value of the retirement benefit is, 1/3 is paid out as a lump sum, 2/3 are reinvested into an annuity product, and the individual then gets monthly annuity income. And the proposal to encourage preservation was to move provident funds across to pension funds, the 1/3, 2/3 rule. And there was objections at a very late stage in February 2016 by COIDA, if I remember, and that led to these postponements. I think it's going to happen. There are legitimate concerns from provident fund members. Remember that if you are older being above 55, then you are starting to think about your retirement. Possibly you're starting to make plans, and your plans are based around this expectation of getting 100% lump sum in cash. What are you going to do with that cash? Okay. Now the law changes, and instead of getting 100% lump sum, you're going to get 1/3. Okay, and you'll get monthly annuity income. But obviously that changes your plans, and the later in life this happens, the more disturbing it can be. And the law has been, I think, very well designed to protect what's called the vested interests of these provident fund members. Vested interest being, you have this expectation. This is what the law has always said. This is what it should do. And now what it should do is going to be changed. So broadly speaking, I'll deal with this again in more detail next year. But if you're 55 or older, in most cases, you will still get your 100% lump sum. Okay. Whatever has been contributed to the Provident Fund up to March 2021, when this comes into effect, when you retire at a later stage, the portion of the retirement benefit that's based on those contributions up to March 2021 will be paid out still as 100% lump sum. What has been invested after March 2021 in terms of contributions to the retirement fund, that will be kept track of separately, and that will in the future, for those under the age of 55, be paid out 1/3, 2/3. If, however, you are 55 or older, you will also get that as a full lump sum. So that's broadly speaking how the law has taken vested interest for Provident Fund members into account, which I think seems quite adequate. And the principle of preserving your savings in your retirement fund is obviously cardinal, it's critical for every individual in the country. Good. That is what's going to happen. We're now into the murky depths of the TERS benefit and the latest changes. As I said earlier, some of you might have been or attended the Power 2020 conference of PaySpace, and I gave a more detailed presentation on TERS benefit, sort of from A to Z, which was over a long period of time, which I can't do now. We've got about 20 minutes or perhaps a little more left here. So I'm just summarizing a little bit where we are and the latest events to bring you up to date. If necessary in the future, if you would like, contact PaySpace and we can maybe look at doing the fuller TERS benefit webinar again in the future. Right, let's again start with the basic legislation and the history of this rollout is not good. If you look at it here, and I'll explain why some things are in red just to draw your attention to it and others not. But just going back, as I said earlier, the state president announced the national state of disaster on the 15th of March, and the lockdown was put into place after that from 1 minute past midnight on the 27th of March. So in between, under a lot of pressure, the one tax relief measure, which as I said earlier goes directly to employees, is the UIF COVID-19 TERS benefit. The other tax relief goes mainly to the employer, which benefits the employees. This goes directly to the employees, any employees who are under financial stress as a result of COVID-19. Now, the first was called directive, strange word for a piece of legislation, directing you what to do, issued at the start of the lockdown and effective for 3 months, incidentally, from the 27th of March, and there's a Gazette if you want to look at it. It was followed rapidly by changes, amendments to that directive. 8th of April, the 4th of May. Then, together with that amendment, on the 4th of May, there was a specific correction of the earlier directive, okay? Retrospective to the 27th of March, and I put that in red because it was only at the point of that correction that it was clear how to calculate, or reasonably clear, how to calculate the TERS benefit. The directive, and if you followed the directive requirements and you tried to do a calculator, which I did, you kept bumping your head against a wall. And when they corrected certain aspects of the directive, it made the calculation clearer. And I remember that a short time after that, I completed a TERS calculation, a spreadsheet, and it was version 14, which explains how many iterations were happening between me and the fund. They were helping in this process up to then. By the way, the calculator is now on version 18, and we'll hopefully be able to have a look at it just now. So then we had further amendments, 15th of May, the 26th of May. May was closed down, if you remember, for applications for the TERS benefit. And we now have dated the 13th of August, one amendment to the directive, so further changes, and accompanied by an explanatory memorandum, which has been done by the law firm of Holt & Cheadle, who is one of the architects of the BCEA, a very capable man in labour law terms. So that's the most recent, effective from the 27th of June. Why effective from the 27th of June? Because the original directive and its subsequent amendments were effective for 3 months from the 27th of March. So if they had done nothing, then the whole TERS legislation framework would have collapsed on the 27th of June, 3 months later. So this actually just picks up the original directives, their amendments, and carries them forward again in another process. And that process, as we'll see at the moment, is linked to a benefit up until the 15th of August. Okay. Talk a little bit more about it. And unfortunately, this amendment also seems, I'm still busy with it now, it seems to have slightly changed the calculation as well of the TERS benefit. Right, so that's where we are as far as the legislation is concerned. The TERS benefit legally will continue until the 15th of August. I have my opinion on the future, which I'll give to you just now. Good, let's just look at aspects of this latest amendment to the directive. They call it now a direction. And what is very confusing and hasn't yet been quite resolved is that they specifically mention 3 categories of employees whose employers, it's quite clumsy in the legislation, are entitled to claim the TERS benefit. So the new direction focuses on these 3 categories. Let's just run through them and then try and wrap it up. Firstly, employers who are not permitted to commence operations either fully or partially. We all know, some types of organizations, companies are not yet back in work at all. Others are partially in work, 1 week here, 1 week there, 1/3 workforce, whatever. So this applies obviously to all of those. It implies that employers who are fully operational, are no longer entitled to the TERS benefit. That's what it implies. Okay, I'll try and explain my thinking on that as well. Then they make specific provision for vulnerable workers, those over, I think it's the age of 65 or with comorbidities, who have to work from home, even though you should be working from the workplace. They are, or the TERS benefit is available to them specifically. And then a more general one here, point 3. Those employees and employers who are unable to make use of the employee services, either fully or partially, because of operational requirements. The ETSOS, the economical, technological, etc. requirements, which has been caused, this interruption to the employer's business, okay, to their operational efficiency, has been caused by these regulations and directions. And one can just think of restaurants and travel agents and bottle stores and employers in general who've had to comply with the Disaster Management Act's regulations in the level 5, the level 4, the level 3 lockdown procedures. So, they just mention examples of rostering, staggering working hours, shifts, short time, introduction of shifts. All of those employees and employers who fit into this category, the TERS benefit is available to them. Now, the interpretation of these 3 groups of employees, the general interpretation by most people that I've seen, in fact, by everybody that I've seen, is that entitled to claim the TERS benefit. In my opinion, and I think I'm fairly alone in this, but in my opinion, this direction is an extension of the previous direction, which was perhaps broader. And because it extends that previous direction, everybody who was entitled to a TERS benefit previously is still entitled to a TERS benefit. And that the purpose of these 3 was just to make it clear that these employers/employees can claim the TERS benefit. That's my understanding. I have, since 2 weeks back at least, put a formal request into the Department of Labour and Employment Insurance Fund to give me an interpretation, a clear interpretation. My understanding is they're sympathetic with my opinion, but that doesn't matter. We have to get something in black and white from them. And it's perhaps significant. In fact, it is significant, where normally they are very quick to respond, that they have not responded in this case. However, I do know that in these past couple of weeks that the auditors have been with the fund, and I do know that it was just not going well with the audit. And if you read the press yesterday, you will see that the senior members, including the UI Commissioner, senior management, precautionary stay-at-home requirements have been put into place. And that obviously has impacted on their whole process of assisting from the senior level with things like I've requested here, an interpretation. So I think that's frozen this process a little bit. I'm not likely to get an interpretation in the next couple of days or the next week, I think. It begs the reasoning to say, what really is the difference between what this says, if you take this as being the law, compared to what it was? And in my opinion, you'd have to look very carefully with a microscope to look at whether there are categories of employees who used to be eligible for TERS and who are no longer eligible, if you take the viewpoint that this is it. I don't think that there are too many. I think that the broad principle remains that employers and their employees, if they are under financial stress as a result of COVID-19 and the regulations and the changes and the lockdowns and etc., that those employees are suffering financial stress because the employers are under financial stress as a result of COVID-19, and that they are entitled to TERS. So, that's my opinion. In other words, my opinion is I think it's actually pretty much business as usual as far as the employees are concerned. I reserve the right to advance rapidly in reverse if I'm wrong. But let's see. And I actually wonder with a short time frame, we already passed the 15th of August. The next question is what's going to happen to TERS into September? And I'll talk about that just now. Good. This is a very confusing slide, a lot of detail. Its sole purpose is just to give you some words from the underlying legislation, these directives. And I'm not going to go through it in detail at all. I just want to point out how it works. This here is the clause number in the directive. So say 3.5, for example. This is how it was issued on the 26th of March with those words. It was amended not too long later on the 8th of April, and it is now been amended again. The yellow highlighted amendments are the recent ones, the 13th of August, those three, which is why I've just got these clauses on the slide. So that's the history of these changes, which you can see is repeated here. Strangely, they've swapped around the requirements on the 13th of August between clause 3.6 and 3.5. What is here for the 13th of August belongs there. And what's there for 3.5 for the 13th of August amendment belongs here. So by now I've confused you completely. If you want to read through this over a nice glass of something strong tonight, then you can do it. And the highlighted in red words are the significant changes. Okay. So I think let's leave it at that. I'm going to pick up on a few things when we come to the calculations where we refer back to clause 5.3 and to 3.5, which deals with a minimum of 3,500 per month. Okay. Good. Then the other major surprising, I have to say crazy change that was brought in by this 13th of August direction amendment change is that the concept of remuneration, the definition of remuneration for the purpose of the TERS benefit calculation has changed from being linked to pay-as-you-earn remuneration or fourth schedule remuneration, and it's changed from that to being remuneration as defined by the Basic Conditions of Employment Act. And there are significant differences between the two. There is a definition in the BCEA. The definition of remuneration in the fourth schedule is a long thing. You're probably reasonably familiar with what is fourth schedule remuneration. Here is remuneration in labor law terms, any payment in money, cash, or in kind, employer contributions or benefits, something that is not paid in cash to the employee. So that's employer contributions and benefits. Okay, benefits are usually problematic area, or both in money and kind. Okay, made or owing in return for that person working for another person. So the person working is the employee. The other person for whom you work would obviously then be the employer. So remuneration is money paid in cash or in kind as a result of work being performed, or in shorthand terms, as a result of work done. The employee does the work. The employee is entitled to be paid remuneration for that work. Okay. So then the explanatory memorandum from Holt and Cheadle makes it clear that their intention, which they're entitled to do, is that any gratuitous type of payments, as I refer to it, tips, leave specifically, payment in terms of annual leave that's been around for a while, is not included for the TERS remuneration purposes. Loans and an advance on remuneration is not included in remuneration. Now, it goes a little bit further. One must realize, as I said, that UIF contributions are based on the fourth schedule definition of remuneration. The benefit is based on the labor law definition of remuneration. And this is an insurance product. So there's a premium and there's a payout. And the calculation of the premium and the calculation of the payment, in the case of a benefit specifically, should be on the same base of remuneration. Now they've changed the base as far as the TERS benefit calculation is concerned. So nothing changes as far as contributions are concerned. That will still be calculated on the same base of remuneration, fourth schedule. It will still happen as it's always happened. But the payout is no longer linked to the same financial or to the same remuneration base. Not satisfactory at all. Here are some of the differences between, and remember the TERS benefit up, this is from July that the BCEA remuneration comes into effect. April, May and June, the TERS benefit was calculated based on fourth schedule remuneration. It's from July onwards that it's based on BCEA remuneration. What are the big differences? All allowances, what we call allowances, excluding specifically the housing allowance, which is it's really a subsidy, not an allowance, and the car allowance, as Labour calls it, the travel allowance. But all other allowances are not remuneration for BCEA purposes. They are remuneration for the fourth schedule. There's specific rules for the travel allowance, but it is taxed, as is all other allowances, whatever you call them, dog allowances, cat allowances, whatever, sandwich allowances, they're all remuneration. So here's a major difference, because in labor law terms, an allowance is something paid to allow the employee to work. It's not the payment made in return for the work done, it's to allow the employee to work. The transport allowance, as I mentioned earlier. Then we come to benefits. This is a grey area of note, the difference between tax law and labour law. Benefits are non-cash grants made as a result of the employment relationship. Now, the 7th schedule for pay-as-you-earn purposes is very specific. It names, defines, gives a value to a whole range of benefits. We call them fringe benefits. Most of them are taxable. In some cases, there's an exclusion or an exemption under specific circumstances. But it is an extensive list, finely detailed, as to what these non-cash benefits are in tax terms. And then that tax value is taken across into the 4th schedule, and it is then taxed for pay-as-you-earn purposes and for skills development levy and so on, and for UIF remuneration. So in labour law, they say if the benefit is not in respect of work done, then it is not a benefit in kind. Okay, therefore it's not remuneration. Now, you know, we can have a seminar for a whole morning, which Andrew Levy and I did in the old days, to try and dig into these things, and it's still a difficult area. So yeah, another major difference is that commission is now remuneration for the BCEA, because it's a payment as a result of work done, but it's specifically included for UIF contribution purposes. So there's another big difference. And then lastly, the contribution remuneration excludes non-employment related lump sums. Lump sums paid by retirement funds or lump sums paid at the end of employment, when employment has ended. So, you know, one can look at those and you'll find differences again between BCA and the 4th schedule. So, you know, the explanatory memorandum uses in it, if you look at it, it puts in there one sentence which says broadly that the purpose of this change to BCA remuneration is because of the fund being under financial stress. So they are saying that, you know, broadly, BCA remuneration is a lower value than 4th schedule remuneration. Therefore, the TERS benefit should be less. But actually what the TERS benefit does is it looks at the gap between the remuneration you were paid in the month, your actual remuneration, and what you're normally paid. So, you know, now one has to look at, okay, is this one in terms of labour law, what you actually paid? It is from July. What happens to your normal monthly remuneration? That was last specified, say in March. That was the last normal period of payment of 4th schedule remuneration. So you stick to that. So now the gap is getting bigger as I see it. It really, let's just say it's mind-blowing. I don't want to use the word crazy again. I don't understand it. It was done in NEDLAC between Labour and business and government. At a high level, I just feel that it was not properly thought through, and I shouldn't be saying things like that. Let us move on, and let's just get a little bit more practical around the application of the TERS benefit. And I see I'm running out of time. If you don't mind, we're going to carry on till the end of this, take a 5-minute break, and then do the questions. These are just the, you know, the more important fields around the application. I'll just touch on them now because of these changes. Just to say these periods, you have a big period of the lockdown in which the TERS benefit was available. That's a bigger period. It was initially 3 months, extended now. Within that, you have what's called shutdowns. And you can see that you have shutdown dates from and until, start and end, within the application spreadsheet. So that's a period that, a shorter period that falls within the lockdown, which up to now was a month-by-month shutdown. It was April. Okay, April went back the 27th of March, so it was 35 days. But it was April, it was May, it was June. Okay. Now, what we have, which we're coming to, is from July, we have a shutdown period specified by the director to be 6 weeks, 1 July to the 15th of August. So we're no longer in a month-to-month situation. It causes complications because, as you know, payrolls run on a monthly basis. Remuneration is more or less tidied up per month. And now we have a 6-week period. And then just lastly, of course, if the employee starts or ends his or her employment within the shutdown period, then there are those dates also specified, which narrows the period of the benefit period being claimed. And the benefit period being claimed is critical because it determines the number of days, and the calculation of the TERS benefit, which we'll see now, uses the number of days times a rate per day to calculate the value of the TERS benefit. So these periods are critical in terms of the days. So that's why I said here that the shutdown dates, which we now have 6 weeks, 1 July to the 15th of August, which I think is 46 days, and the remuneration paid within those 46 days, they must be in alignment with one another. Whereas the monthly remuneration, that's your normal monthly remuneration, that probably might still be as it was at the end of March, when you last had a normal remuneration month. Okay, let's move on. The benefit calculation principles may be something that you must have a look at again at a later stage. I did do it in the earlier PAGSA conference in detail, but these are the basic calculation steps. The scenario here is the employee's normal monthly remuneration is 20,000 Rand. So firstly, there's a maximum that is applied throughout all of the UIF 9 benefits. And that maximum is the benefit limit that I showed you earlier of 17,712. So the monthly remuneration, what happens if you're paid 20,000 Rand, the benefit works on 17,712. Okay. Then your daily remuneration rate is your MR, monthly remuneration, times 12 divided by 365. If you're on the maximum of 17,712, that gives you a maximum daily benefit or daily remuneration rate at this stage of 582.31. You cannot get a benefit for any type of benefit that's calculated at a higher rate per day than 582.31. Then certain types of benefits, those benefits that don't have children involved, use the income replacement rate, and there's a formula, it's this cross-subsidization formula, and it gives back a value between 38% and 60%. High income, low income, cross-subsidization. A high income person is anybody who earns above the limit. So the result of this formula is 38%, the lower percentage value because of the cross-subsidization. So all that gets plugged into this formula is the DRR value. 582.31 is put in there, you'll get a result of 38%. Then getting closer to the benefit, the daily benefit amount, so you have a daily remuneration rate and a daily benefit amount, is the daily remuneration rate times that percentage. So 582.31 times 38% gives you a daily benefit amount of 221 per day. And then for TERS only, we have a minimum. All benefits have a maximum. For TERS only, we have a minimum. If that amount is less than 115 Rand and 7 cents per day, then 115 Rand and 7 cents is used in the calculation. In other words, it's increased. That value is at 3,500 Rand per month that I pointed out, times 12 divided by 365. Then the last step is simple. You look at the shutdown period, as I showed you earlier. For June, it was 30 days. For 1 July to 15 August, it's going to be 46 days. And you multiply those days by that value or the adjusted value, and you get the benefit amount. And here in a normal 30-day month, this was the benefit, the maximum benefit, because the maximum situation 6638.40. Okay. Is a last refinement that if you paid additional remuneration, this is only looking at your normal monthly remuneration, but if you're paid 5,000 Rand during the month and your benefit is 6638, then you will only get 1,638 Rand in terms of benefit because you have been paid 5,000 Rand. Okay, it's a broad principle there. Good. Here are a number of examples for you of the monthly remuneration, you know, going up and down. The daily remuneration rate, it's adjusted down to the maximum. If there's the IRR percentage, you can see how it goes from low to high. Well, to there was highish, okay. Here, 60,000 Rand a month goes back to low. Then the daily benefit amount, how that changes under the scenarios, and then the calculation of the benefit and the final benefit amount. Just for interest's sake, and this is still the case, if you have an employee who's normally paid 60,000 Rand, okay, prior to the lockdown period, they take a cut to 50,000 Rand to assist the company during the lockdown period. That individual is still entitled to a benefit, even though they're being paid 50,000 Rand. If this had been 55,000 Rand, then only 5,000 Rand of benefit would have been paid. So, you know, the TERS benefit is not only for low income employees, it applies to any employee who is suffering financial stress. It sounds a bit funny if you're being paid 50,000 Rand, but if your remuneration has been impacted on as a result of COVID-19, if that's the case, you can still get a benefit. Anyway, I'm now going to quickly, we're running out of time, just go into the calculator if everything works nicely, and just show you the calculator. And by the way, the calculator is available. I will give it out, you know, obviously free of charge. You'll see there's an email address, my PAG email address. You can send me an email there, or you can contact PaySpace. I've made it available to PaySpace as well. So just while I cough and just change to the spreadsheet, just give me a minute or so. And there we are. Hopefully you are seeing a spreadsheet in front of you on the screen. And just to explain a few things very quickly for you, this is version 18. And the spreadsheet is protected so that the formulas are protected, but the 4 green fields there, the shutdown start date, the shutdown end date, the monthly average remuneration, that's a normal monthly remuneration, and then was there any remuneration paid during the shutdown period? Those 4 green fields is where you can, you know, capture the information, and you can do some modeling, forecasting, calculations. The TERS benefit value is kicked out in the yellow field at the bottom there. So that's how it works. Just for interest's sake, you can see here that the period is June, 1st of June to 30th of June. So 30 days are used in the calculation, which is repeated down here. As it stands, the spreadsheet, this employee has got no normal monthly remuneration. And I just left it like this to show you, for interest's sake, that the income replacement rate, when there's 0 remuneration, that's when the 60%, the highest percentage, kicks in at 0. If I change that to be 1,000 Rand remuneration, then you'll see that the income replacement rate has now changed to be slightly less, 56.19%. If I make that 10,000 Rand, which I didn't do right, then the income replacement rate drops down to close on 42%. Okay, and obviously the benefit is changing the whole time while I'm doing these things. So if I put in 17,712, the maximum, you can see there the income replacement rate is 38% over there. Or 20,000 Rand, the same result would be, or 60,000, whatever. Income replacement rate stays there. Here's the 60,000 example. There's a matter of interest that I showed you on the previous slide. The maximum benefit would be 6638. It would be that times 30. If the person was paid 50,000 Rand, they would still get a fringe benefit, a TERS benefit of 6638 if the monthly remuneration paid was 55 paid. Then I said 5,000 Rand is because we're using daily calculation instead of a strict monthly figure, and we're working with a 30-day month. It changes if there's a 31-day month. If you work with a 30.4166 average days per month, it works out exactly. So that then is close to 5,000 Rand. Yeah, I think perhaps as a result of shortage of time, I've explained how it works. Let's move back. And as I say, this calculator is available either from me or from PaySpace. Oopsie, what's happening here? That's where I should be. Apologies. Good, so we're back on that, just showing example screen. Let's move on. This is just to say in terms of payslip administration that firstly, the TERS benefit is exempt income. It's exempt in terms of section 10(1)(MB). It is not income. It is therefore not remuneration, because remuneration is linked to the concept of income. If it's not remuneration, it is not taxable at all. It's not remuneration. So none of those apply. There's also no tax certificate code, because the best is to process the TERS benefit through the payroll. Because the procedure, of course, is an application is made for the TERS benefit. If approved, the fund pays whoever was specified on the application, normally the employer. It can also be the bargaining council, it can be the employee directly. Whoever's bank account is there will be paid. Let's assume that the employer gets paid. So 10,000 Rand of TERS gets paid to the employer in respect of 10 employees, each of 1,000 Rand. Let's make it simple. The employer has the legal obligation that they must pay forward that 10,000 Rand into 10 employees at 1,000 Rand each, and that the employer in the next application for TERS must provide proof, bank statement proof, that those payments were made. Okay, so this is to prevent that type of fraud where the employer just retains the money. We can see there's been other types of fraud. There's, I think, about 20 cases of TERS fraud where they got more clever and somebody along the way diverted the TERS benefits, millions, into personal bank accounts, which makes one think that there must have been some collusion, unfortunately, within the fund, and possibly, is behind, what's happening at the fund now at the moment, sadly. Okay, but the employer is just an agent of the fund. In terms of the payment of the TERS benefit, the company is an agent, you're not an employer. Okay, hence no tax certificate code. I'll repeat it because there's huge amount of queries. Now, advances, an advance on remuneration, an advance on amount that is taxable, is also taxable. However, if you pay an advance on something which is not taxable, it is not taxable. Okay, so the TERS benefit is not taxable, and you pay an advance on that non-taxable amount. Therefore, it's not remuneration, no pay as you earn, etc. Okay, so it's a good way, in my opinion, of trying to assist the employees to be able to survive, to have some sort of cash flow by paying in advance, because as we all know, and the history was problematic, that you apply for the April TERS benefit and you only get it in June, you know, and foreign employees, there's still delays around them. So pay in advance, then, and it is now specified in the directive, you are legally entitled to set off against, you set off the advance on TERS against the benefit, the R1,000. So it's obviously always best to pay a lower advance amount, lower than what you expect the TERS benefit amount to be, which is the reason why I've made the calculator available, that you can get a reasonably accurate idea of what the TERS benefit should be, okay? And just, you know, make it a bit lower. Good. I think that this is still a valid principle and practice for the future. Just to say around the reduced work time benefit, that it is an alternative to the TERS benefit, but it is a very sad second cousin to the TERS benefit in terms of the value that you get if you apply for the reduced work time benefit. Very briefly, the reduced work time benefit, as I showed you earlier, came into effect from the 1st of January 2019. So it's a new kid on the block. It is designed around short-term arrangements. Short-term arrangement is where the employers in financial difficulties, the employer gets together with the employees, including bargaining councils and unions if they are. They have an open discussion, the financial information is put on the table. The options generally are retrench, close the company, close the factory, retrench that group, or move on to short term. Those are the broad options. They discuss. If they agree on short time as being better than retrenchment, I'd rather have still have a job and get paid less than having to stand in the unemployment queues, then it goes the short time route. And they agree on 6 hours a day instead of 8, or 4 days a week instead of 5, or 2 weeks a month, or whatever. It's a short time arrangement. And this benefit was put in place to assist the employee with a gap between their normal wage and their short time wage. It's a good principle, it's a good intention. However, this benefit makes use of credit days to calculate its value. And remember, credit days accumulate over the 4-year period. Whereas, and I'm just going to move back on the slide, stay where you are, well, you can't go anywhere anyway. The TERS benefit calculation uses the number of days specified by the shutdown dates. For June, 1 June to 30 June, that's the period being claimed. It's a fixed number of days, 30. It will be 46 days from the 1st of July to the 15th of August. So the TERS benefit calculation does not make use of credit days, which is one of its major advantages. The other advantage I can point out here again is the TERS benefit has a minimum. You won't get less than 115 Rand and 7 cents a day, even if you are normally paid less than 115 Rand and 7 cents a day. It's actually beneficial to these employees. They're getting more than normal. Whereas that is not the case with the reduced working time benefit. Okay. So the RWT uses and then reduces the accumulated credit days, which means because they've been translated into a short-time benefit, they're not available down the line should the company eventually end up in a retrenchment situation and there should be an unemployment benefit. They're not available. And secondly, remember that these credit days are used to calculate a benefit value, which is in line with the value difference between, shall we say, 6 hours a day and 8 hours a day. So the financial value is reduced, but you're using 1 day. For unemployment, you're using 1 day for a full 8-hour day value. So, it's a significant it has a significant impact on employees down the line if you use a reduced working time benefit. However, when TERS comes to an end, which it will, it is a possibility that employers can consider, because you might still be obviously on times are still tough, so you're on short time. Good. So I will be doing a reduced work time calculator in about a couple of weeks, I think, because I think we're heading to this. As soon as TERS ends, then reduced work time benefit will potentially be used more widely. A couple of questions quickly. So we're getting on to question time. We're nearly at closing time, so I'm far over my time here. The question of foreign nationals, and will they be paid? There have been huge delays. It's to do with problems around identity. It's to do with problems in the UIF system. It's to do with the speed and the pressure that the UIF were under to get this TERS benefit up and running. So the delay generally for foreign national is around the passport number, the identity number. They have to, the UIF has to go to the Home Affairs, they have to go to SARS, they're getting verification of these numbers. I believe that the process is speeding up. I believe that they're catching up with previous applications. Okay. In principle, in law, these employees, the foreign national employees, are entitled to a TERS benefit just as what a normal South African resident employee is entitled. Now, the question of multiple employers is pretty widespread. Obviously, in farming areas, you can have a seasonal worker working for Farm A for a week and then Farm B for another week. And that seasonal worker is entitled to a TERS benefit. Now, again, because of a lack in the system for TERS, the 3,500 Rand concession, if I can put it that way to you, that you don't get less than 3,500 Rand a month, or the daily equivalent of 3,500 Rand a month, was put into place because what happens for multiple employment, let's say Farm A applies for the same employee for PIT, for a benefit, and a week later Farm B also applies for TERS benefit for PIT. The one that gets approved first or goes through first, shall we say Farm A, the TERS benefit will be paid. Farm B will be refused because PIT is already getting a benefit in respect of that period, you know, the April period or the June period or whatever. And for that reason, the 3,500 was seen to be a sort of a backdoor compensation for these individuals. They are working, they might have 3 employers in a month. They're only going to get one benefit in respect of one period of employment. And because generally these people are low income, they put in the 3,500. Can you claim retrospectively? Yes, you can. You still can. But as soon as they have cleared up the back claims, foreign nationals and general claims for these previous periods, they are going to be closing the window for retrospective claims. Okay. So if you do want to claim now as an employer and you haven't yet, you can still submit claim. Best to do it month by month. Do April, you know, wait a few days, do May, wait a few days, do June, wait a few days, etc. Okay. So just bear in mind, the retrospective window is going to be closed. So these are broad questions that I just thought I'd answer. It might help you. Questions that are not answerable, and I'll just talk around these 3 quickly, and then we'll get to your actual queries. You know, the rules around this calculation have been changing at regular intervals, as you saw from that history of the legislation. It seems like there's another change just been made by the recent changes, but I think it's insignificant. I think that my TERS calculator, the version 18, is still okay. So I think, will the calculation be changed again in the future? I think it can be changed again. And it wraps around into these questions about money and how long will TERS be available. There's no doubt that the initial allocated budget in March for the TERS benefit was 40 billion. And at the interim budget on the, when was it, the 26th of June, there's a reasonably accurate figure that 32 billion of the 40 billion had been paid out. So there's 8 billion left. There is a recent indication, but I'm not sure how accurate it is. It's just a press report that the 40 billion has now been exhausted. It's possible, but I don't know for sure. But certainly they're coming close to the end of that 40 billion as matters stand, and we've now been extended to the 15th of August. The indication that I have is that let me put it, my opinion is that the TERS benefit will be extended for another month until the 15th of September, purely my opinion. I just base it on, I don't see how politically the government can still have a fairly large portion of the employed workforce suffering as a result of COVID-19 and take away the benefit which goes directly to them, which is the TERS benefit. I don't think that would be a politically good move. And I'm not a politician, but it doesn't seem to be, to me, to be a wise move. So I expect, and it's purely my opinion, that we're going to see another month. Another month will mean more money. So it seems to me that they are going to have to get additional funding, reallocate, perhaps the fund still has a bit of a surplus left, reallocate funds from somewhere. And that might even be necessary for now up to the 15th of August. More than likely, if it goes to 15th September, you know, more money is going to be needed. Beyond that, it's difficult to predict. Yeah, but that's it. Yeah, you've got these slides. You know, here's an email address for me, and on the very last slide, I gave that same email address if you want to contact me for the TERS calculator, but otherwise you can contact PaySpace, and they have it, and they can issue it to you. It's now 25 to 1. I'm sorry I'm over my time. I don't know how many questions there are and how much they've been consolidated down to, but I think if you're interested in the questions, let's take a 5-minute break to give us time to get to grips with the questions. And then I'll be back again at 22:01 and deal with the questions. Thanks. Right, everybody. Let's have a look at these questions. And this is a little bit new to me. I think I'll just have to scroll down here. Just while I'm trying to fiddle my way through this thing. Just to say that when I come to questions, obviously I will hopefully be able to answer the questions. We will also be doing a FAQ document. Sorry, I'm just looking at the screen as I'm talking to you. We'll be doing a FAQ document as well. So anything, sometimes these questions need a little bit of investigation. If I can't answer, I'll say so. And, you know, we'll issue obviously those FAQs to everybody at the end of the session. I thought that there were 8 questions. I only see one here in front of me, which is from Tracy, and asks the question, is the RWT an option on the UI19, or is it a different form? Tracy, look, it's pretty new. It only started in January 2019. And my understanding is that the employee applies, because remember, it's short time. The employee applies and they make use of U-filing now for the application. Now, I think that U-filing is not the most stable system in the world, and there have been hiccups with it, and it's also been impacted upon by the TERS period, by the lockdown period. But my understanding is that you can go to U-filing and apply there. I would assume that the employee can, just with a normal process of a manual application going to the Labour Office, UI19, that you can also do it. So I think the answer is both can be used. I just want to see there's something. Sorry for the delay here. I'm just trying to get down to the other questions because I presume that, oh hell. Let me just try and get back to where I was. Okay, yeah, I see another question now. If you claim reduced working time from UIF and 6 months later you get retrenched and you need to claim unemployment benefits, are your credit days reduced? Yeah, well, I think that this question was posed before we got to that last slide of mine. Without doubt, just to repeat, TERS benefit does not use or reduce credit days. The RWT benefit uses and reduces credit days. So those days used are not available for a later unemployment retrenchment benefit. So certainly, if there's a choice between using the RWT benefit and the TERS benefit, there's absolutely no doubt that you must use the TERS benefit. It has that minimum. It doesn't use or reduce credit days. However, we're going to be moving into a period where TERS will stop and the RWT benefit will still be available, you know, around its purpose, which was for short-time arrangements. And then it is a question of being aware of the shortfalls of reduced working time and making a decision as to whether it is beneficial for the employees to go that route. But in the discussion between the employer and the employee, I think these things should be pointed out. Look, the value of your one credit day is going to be only commensurate with, say, 2-hour gap, 6 hours to 8 hours gap in your wage. So you're going to get a small value for a whole day. If you leave the days and hopefully nothing happens, but should you claim an unemployment benefit later, you'll get more value for your credit day. This should be pointed out. Another thing in these discussions, retrenchment discussions, is on the table must be the fact that not every employee who potentially is moving on to short time has the same amount of credit days. And the number of credit days impacts on the benefit and how long it's paid for. So you can have some employees with 10 credit days, others with 100, and others with 200 credit days. So the financial result can't gloss over those differences. Some employees, you know, will have a very small benefit, others will have a bigger benefit. So it makes the whole reduced working time benefit, in my opinion, well-intentioned, but perhaps something that you must really think about carefully before you apply it. So hopefully that answers your question. Let's just see what's happening here. Okay, similar question. If your company claimed the TERS benefit during lockdown and upon returning after lockdown, they implement reduced working time to avoid retrenchments, can they still claim for RWT? Absolutely, absolutely. The fact that there has been a TERS benefit has impacted on nothing except the fund's bank account and hopefully the employee's bank account who got the TERS benefit. That's all it impacts on. They're not overlapping benefits. You can't have two benefits being paid over this in respect of the same period of time. The one follows the other here, so that's not a problem. And yeah, the TERS benefit didn't reduce credit days, so those credit days will now be used for the reduced working time benefit. So that is fine. I'm just struggling to find out why I can't see. Oh, here we go. All of a sudden this is working. Okay. There we go. Right. With regard to the TERS payouts, which we have paid via EFT to the employee, must the total TERS received to date be reflected on the employee's payslip at the end of September if this has not been recorded monthly? You know, I would say that it is absolutely best practice to record the advances and the payouts of the TERS benefit on the payslip. It will just reduce uncertainties, it will improve communication, it will be transparent, and should you ever have an audit from the fund later, which they are threatening, and by the way, which I didn't mention earlier, I cannot see how an auditor will be able to audit correctly the TERS payments over the last 4 months and the coming month or two, with changes to remuneration, changes to the law, changes to the calculations. But anyway, they intend to audit. So if you have it on the payslip, that's absolutely, in my opinion, best practice. Remember that the advance and the TERS benefit is not taxable, so it's just an in and an out, no tax certificate code. I would really advise it, you know, from those points of view: transparency, openness to the employees, assistance with later audits should there ever be one. Right, and then this question has been posed in different ways. With reference to the TERS EFT payout to the employees, or directly to the employee, can I just show this on the biannual submission and not on the payroll payslips? Yeah, that makes it obviously more cumbersome if the payment goes directly to the employee. I haven't actually seen this myself, but I understand that the employer gets a reconciliation of what the fund paid directly to the employees. So it's potentially possible to use that reconciliation and to process it through the payroll in the same way as what you would have done had the TERS benefit been paid to the employer and then on-paid to the employee. I just think it's good practice. It might be a huge amount of administration depending on how many employees there are. And with the month differences, if I can put it to you that way, you apply in April for April and you get paid in June. The payroll has been running. So there are delays in this process. But I think that if you can do it once and get it right, it will save lots of potential problems in the future when you can't really remember what happened and why was this done and so on. So I would still recommend it, putting it through the payroll. And just to point out, I see the question refers also to the biannual submission, which would be the tax certificate submissions, which is due. Remember that TERS is not shown there. There's no tax certificate code. TERS does not appear on a tax certificate. So there's nothing being shown there at all. The only place where it can be shown is on the payroll, on the payslips. Right, then our company wants to repay the full outstanding amount of the deferral. Okay, do we need to set up each month's repayment separately? This is a question that I can't answer. It's a good question. In other words, you don't want to pay it back over 6 months. You want to pay it in a shorter period, 1 month or 3 months or whatever the case might be. I would have to go to SARS about that. My common sense would say to me that they're not going to turn away, the full 6-month repayment. They're going to accept that money. The question would be, will they allocate it correctly in their system? I would assume that, they'll be looking at the end of the 6-month period of, has the full amount been repaid? The answer would be yes, even if you paid it in 1 month, using that reference number for that month. And I would think that it would be fine. Okay. I will try and get an answer from SARS and put that into the FAQ. But my off-the-cuff answer would be, I don't see a problem with it. Then, with regard to ETI claims, we've not been able to declare our ETI on our June and July MP201 form. It allows you to fill it in on the 201 form, but as soon as you move to the next bracket to complete, it states you may not claim ETI has already been utilized. Has this got to do with TERS by any chance, or what does this relate to from the SARS side? Anonymous there, I think this is where we need a bit of the detail. It can be simply that the claims made already for ETI are in excess of the pay-as-you-earn liability. And this is now just stating that it has already been utilized, that it's already been paid. However, there might be more to this question than what I can see here. So I think, again, I'll have to take this offline, take it up with SARS. Perhaps if you're listening to me now, if you can send an email to ANC and just give a little more detail, that would help in getting to the bottom of this one. Corinne, although the extension of the pay has been made, I'm trying to edit the payment to SARS for the month of August to exclude the deferral value. The system will not allow it. Well, you surprised me a little bit there, Corinne. I know with this extension, which, as I say, has just been put into place in the last couple of days, that there was an indication. I think the indication was that SARS have already changed their system. I'm not sure if it's possible that you tried to do this prior to them changing their system. They certainly intend to change this on the e-filing system. So if that's the answer that you want, they certainly will. Maybe there's a slight hiccup, as what is normally called a bug. But if there's a bug, or if they haven't done it yet and made it available, it will be sorted out. So hopefully that answers your question. Kobe, the company intended to write off loans that were given during lockdown to employees. Since this is illegal, I need to correct this as income. Must I file corrections on my MP201 for all of the months separately, or can I do one together with my August MP201? Could be giving it some quick thought. I think that there's no problem with doing it, on a consolidated basis in the August 201. I can't see that it is necessary. It's not impacting on ETI as far as I can see. These were loans. No. Could be my quick answer. August 2001 should be fine. Anonymous, how do I get a sole proprietor's UIF reference number? I sent emails, etc. to no avail. Yeah, I must say that there are still, sadly, people at the fund in the lower levels who believe that a sole proprietor can't be an employer, and they treat the sole proprietor as an individual. If you need Anonymous, send your details, your details of your sole proprietorship, and to PaySpace, and I can take it up with somebody that I know well at the UIF and try and get this sorted out. There is no valid reason that you're not getting a number. There's just something going wrong. Okay. Right, and I see the last one is from the A of ANC, and thank you for joining us. I just want to say that from my side, it's been a pleasure. It's always a little difficult with the first webinar with new slides. I mean, not certain of the sequence and that sort of thing, but I hope you've enjoyed it. I've enjoyed it. I hope it's been of value to you, and I hope we meet again. Goodbye. Thank you.